Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable, adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the evening deepens? A cozy corner where the weight of the day is finally lifting? Wherever you are, you're exactly where you need to be. Tonight we're going to travel back more than 1,000 years, to a time when Baghdad was the centre of the world, when scholars gathered in lamplight to translate ancient wisdom, when the foundations of how we organise and track wealth were being carefully, patiently built. We'll explore the birth of accounting, not as a dry technical subject, but as a profound human story about how civilizations learned to remember, to measure, to make sense of complexity through numbers. If you drift away as we journey through ancient cities and dusty archives, that's perfectly fine. That's what we're here for. Let the story wash over you like a gentle tide. Let's begin in Baghdad, in the year 800, when the night air was cool and the House of Wisdom was just being born. The Tigris River flows through the heart of Mesopotamia, as it has for thousands of years, carrying silt and stories in equal measure. Long before there were computers, before there were printing presses, before there was even paper as we know it, human beings needed to remember. They needed to track grain harvests and livestock counts, debts owed and payments made, the wealth of temples and the obligations of kings. And so, in the fertile valley between two rivers, in the land the Greeks would call Mesopotamia, accounting was born. Let's step back slowly and carefully to a world so ancient that it feels almost mythical. The year is approximately 3,500 before the Common Era. The place is Sumer, in what is now southern Iraq. The people who live here have developed something remarkable: cities. Not small settlements or temporary camps, but actual cities with thousands of inhabitants, with specialized workers, with temples that rise toward the sky, with administrators who need to organize complexity on a scale humanity has never before attempted. Picture, if you can, the city of Uruk in its early glory. The sun rises over mud brick buildings, over canals that channel water from the Euphrates, over fields of barley that stretch toward the horizon. The city is alive with activity, but not the frantic pace of a modern metropolis. Everything moves with the rhythm of agricultural seasons, with the slow certainty of river floods and harvests. And in the temple complex at the city's heart, something profound is happening. Scribes are learning to write, but they're not writing stories or poems, not yet. They're writing numbers, they're writing lists, they're creating the world's first accounting records. The medium is clay, soft and abundant in this river valley. A scribe takes a lump of clay, flattens it into a tablet that fits comfortably in the hand, and using a reed stylus cut at an angle, begins to make marks. The marks are simple at first, wedge-shaped impressions that we call cuneiform, from the Latin word for wedge. A circular impression means 10, a smaller mark means 1. These aren't decorative, these are numbers as precise and purposeful as anything in a modern spreadsheet. What are they counting? Everything the temple needs to survive and thrive. Bushels of barley received from farmers as offerings or taxes, jars of oil pressed from sesame seeds, ewes and rams and lambs in the temple flocks, days of labour owed by workers, silver weighed out to purchase goods the temple cannot produce itself. Each transaction, each movement of goods or obligation of service, creates a record pressed into clay. The tablets are small enough to hold, but their implications are enormous. For the first time in human history, memory extends beyond the human mind. A scribe who records a debt doesn't need to remember it personally. The clay remembers. A temple administrator who needs to know how much grain is stored doesn't need to walk to the granary and look. The tablets tell the story of what came in, what went out, what remains. This is accounting in its most fundamental form, the systematic recording of economic information. It emerges not from abstract theory, but from practical necessity. the Sumerian city-states are managing resources at a scale that exceeds human memory's capacity. Without some system to track obligations and assets, the whole complex structure would collapse into chaos and dispute. The clay tablets are civilization's memory, pressed into earth and left to dry in the Mesopotamian sun. Let's think about what this means for a moment. Accounting is often seen as boring, as merely technical, as the tedious work of adding and subtracting. But in its origins, accounting is actually quite profound. It's humanity learning to extend itself, to create external memory, to build systems that allow cooperation and trust among strangers. A farmer who delivers barley to the temple receives a tablet confirming the delivery. That tablet is a record, a receipt, a proof. It allows the farmer to trust that his contribution will be remembered, that his obligation has been met, that if the temple owes him something in return, the debt will be honoured. The Sumerians developed a sophisticated system over centuries of practice. They had standard units of measurement, the silla for grain, roughly equivalent to about 1 litre. Larger quantities were measured in gur, with 1 gur equal to about 300 sila. For weight, they used the shekel, which was both a unit of measurement and eventually a unit of account. 60 shekels made 1 mina. 60 minas made 1 talent. The sexagesimal system, based on the number 60, would persist for millennia, giving us our 60 seconds in a minute, our 60 minutes in an hour. The scribes who created these records were specialists, trained from childhood in the complex art of writing. Most people in Sumerian cities couldn't read or write. Literacy was a professional skill, closely guarded, essential for administration. The scribes weren't just recording passively, they were also calculating, solving problems, figuring out fair divisions of goods, converting between different units of measurement. A scribe might need to calculate, if 15 workers each owe 3 days of labour, how many total days of work does the temple have available? If barley is being distributed as rations and each worker receives 2 silla per day, how long will a store of 500 silla last? These calculations were worked out on the tablets themselves, which sometimes show the scratchwork, the intermediate steps, before arriving at a final answer. The tablets are accounting records, but they're also mathematical documents, showing human beings grappling with quantitative problems using the tools they had developed. As centuries passed, the Sumerian civilization gave way to others, the Akkadians, the Babylonians, the Assyrians. Each inherited and built upon the accounting systems of their predecessors. The clay tablets continued, now recording ever more complex transactions. We have tablets recording loans of silver, with interest calculated at a specific rate. The Code of Hammurabi, dating to approximately 1750 before the Common Era, contains detailed provisions about commercial transactions, rates of interest, responsibilities of merchants, rules for contracts and deposits. One section of Hammurabi's code, for instance, specifies that if a merchant gives silver to an agent for a trading venture, the agent must write down everything he spends and calculate the interest. Both merchant and agent must have copies of the accounting. If the agent loses money through negligence, he must repay the merchant. But if he's robbed on the road, he swears an oath and is absolved. The code assumes accounting, assumes written records, assumes calculation of interest. These aren't novelties, but established practices being codified into law. The interest rates mentioned in Babylonian records are fascinating. Silver loans typically carried interest of about 20% per year. Grain loans, because grain can spoil and fluctuate in value with harvests, might carry interest of 33 1/3% per year. These rates seem high by modern standards, but they reflect the realities of risk in an ancient economy. The important point is that they were calculated, recorded, and expected to be tracked through proper accounting. Archaeological excavations have recovered thousands upon thousands of these clay tablets. The city of Ur, one of the great Sumerian city-states, has yielded tablets recording everything from temple construction projects to the rations given to workers. we can read in remarkable detail. The economic life of a city that flourished 4,000 years ago. We know what workers ate, how much they were paid, what materials cost, how long projects took. We know this because scribes, working in the heat of Mesopotamian summers and the relative cool of winter, carefully pressed these records into clay and preserved them. There's something deeply moving about these tablets, if you let yourself think about it. Each one represents a moment of human interaction, a delivery made, a debt acknowledged, a payment received, a contract agreed upon. The scribe who made the record is dust. The farmer who brought the barley, the merchant who weighed out the silver, the temple administrator who checked the accounts, all are gone, vanished into the vast silence of the past. But the tablet remains, a small fragment of baked clay bearing witness to their existence, to the economic life they lived, to the systems they created to organize cooperation and trust. The clay tablets teach us that accounting isn't merely about money or profit. It's about memory and accountability, about creating systems that allow complex societies to function. The very word accountability shares its root with accounting. To be accountable is to be answerable, to have your actions recorded and remembered. The Mesopotamian scribes were creating the infrastructure of accountability, making it possible for temples and palaces to manage resources, for merchants to conduct trade over long distances, for individuals to trust that their contributions would be remembered and their entitlements honoured. As the Mesopotamian civilizations rose and fell, their accounting systems persisted and evolved. The tablets grew more sophisticated. By the Neo-Babylonian period, around 600 before the Common Era, we find elaborate banking operations in cities like Babylon and Sippar. The Egibi family and the Murashu family ran what were essentially banking houses, making loans, taking deposits, facilitating payments across the vast Persian Empire that had conquered Babylonia. Their archives, preserved in clay, show complex networks of credit and debt, regular accounting of interest, careful tracking of assets and liabilities. These weren't primitive people fumbling toward economic organization. They were skilled professionals operating within a sophisticated financial system, one that required careful record-keeping to function. The clay tablets were their ledgers, their receipts, their contracts, their audit trail. Everything was documented because everything had to be documented. Trust in an economy requires memory, and memory, in an ancient world without printing or digital storage, meant clay. Let's sit with this image for a moment. A scribe in ancient Babylon, perhaps in the year 500 before the Common Era, working by lamplight as evening falls. Before him are tablets recording the day's transactions. A farmer has deposited grain with the banking house. A merchant has borrowed silver for a trading venture to Phoenicia. A temple has paid for construction materials. Each transaction has been recorded, each amount noted, each obligation documented. The scribe's work is meticulous because it must be. Errors could lead to disputes, to losses, to the breakdown of trust that holds the whole system together. The work is repetitive, even tedious. Press the stylus into clay, form the wedge shapes that represent numbers and words, let the tablet dry, store it in the archive with thousands of others, organised by date or by type of transaction, or by the parties involved. But this tedious work is actually profound. It's the work of building civilization, of creating the systems that allow strangers to cooperate, that allow wealth to be accumulated and transmitted, that allow economic activity to extend beyond the immediate and local. The rivers keep flowing, carrying their silt and their stories. Civilizations rise along these banks, flourish for centuries and fade. But the clay tablets endure, buried in the ruins of ancient cities, waiting for archaeologists millennia later to discover them and read the stories they tell. Stories not of kings and battles for the most part, but of ordinary economic life. Bread baked and beer brewed, sheep shorn and silver weighed, debts paid and obligations met. the everyday accounting of everyday life preserved in clay, teaching us that our modern obsession with tracking and measuring and recording has roots that reach back to the very beginning of urban civilization, to the moment when humans first needed to remember more than any individual could hold in mind. And this is where our story truly begins, because these clay tablets in Mesopotamia are the foundation upon which all later accounting systems would be built, including the sophisticated methods that would emerge more than 3,000 years later in the Islamic Golden Age, in the courts and marketplaces of Baghdad and Damascus and Cairo. But we're getting ahead of ourselves. For now, let that image settle, a scribe in Mesopotamia, a clay tablet in hand, creating the first accounting records, building the first systems of economic memory. Everything that follows, the ledgers and journals and balance sheets of later civilizations, grows from this simple, profound innovation. The decision to press numbers into clay and let them speak across the silence of centuries. The clay tablets of Mesopotamia were still being written when a new civilization rose to power far to the west, around the Mediterranean Sea. The Romans, who had come to dominate much of the known world, inherited many things from the peoples they conquered: Greek philosophy and art, Egyptian engineering, the gods and goddesses of a dozen different cultures. But they also developed something distinctly their own, an elaborate system for managing the finances of the largest empire the world had yet seen. And like the Mesopotamians before them, they understood that empire required accounting, required memory pressed into permanent form, required systems to track the movement of wealth across vast distances. Let's move forward in time, slowly and carefully, from the clay tablets of ancient Babylon to the wax tablets and papyrus scrolls of Rome. The year is approximately 100 before the Common Era. The Roman Republic is transforming into an empire, though the participants don't yet know it. Julius Caesar is still a young man. The Mediterranean is becoming what the Romans call Mare Nostrum, our sea, as Roman legions conquer territory after territory, bringing them into a single political and economic system. Roman accounting didn't emerge from nothing. The Romans were practical people, more interested in what worked than in theoretical perfection. They borrowed freely from the Greeks, from the Etruscans who had preceded them in Italy, from the Carthaginians they fought and eventually destroyed. But they adapted what they borrowed to their own needs, and their needs were immense. An empire spanning from Britain to Mesopotamia, from the Rhine to the Sahara, required unprecedented administrative sophistication. The basic Roman accounting document was the Codex Accepti et Expensi, the account book of receipts and expenditures. This was maintained by the head of each household, recording money received and money spent. For a wealthy Roman family, this might be a complex document indeed, tracking income from multiple farms and business ventures, recording expenses for food and clothing and entertainment, noting loans made and debts owed. The Codex was a legal document, admissible in court, proof of transactions and obligations. Roman aristocrats took accounting seriously, not as a technical detail to delegate entirely to slaves or freedmen, but as an essential part of managing a household and fortune. Cato the Elder, writing in the 2nd century before the Common Era, advised in his work De Agricultura that a landowner should regularly review his accounts. Checking the farm manager's records against physical inventory. Count the wine jars, he wrote. Count the grain storage. Check the tools and equipment. Verify that what the manager claims to have matches what actually exists. Trust, but verify through accounting. The Roman government developed accounting systems far more elaborate than any household. The aerarium, the public treasury housed in the Temple of Saturn in the Forum, maintained detailed records of the Roman state's finances. Money flowing in from taxes and tributes, money flowing out for military pay and public works and grain distribution to the urban poor. All of it was recorded by teams of scribes and clerks. The records were kept on tabulae, wooden tablets covered with wax on which records could be inscribed with a stylus, then smoothed over and reused. For permanent records, they used papyrus or later, increasingly parchment made from animal skins. The Roman system distinguished between different types of accounts. There was the adversaria, a daybook or journal where transactions were first recorded as they occurred. These rough notes would then be transferred to the codex, the formal account book organised by category or by person. This two-step process, initial recording followed by organised posting, is a precursor to double-entry bookkeeping. Though the Romans never quite developed that system fully, they understood that every transaction could be viewed from multiple perspectives, that money going out from one person was money coming into another, but they didn't create the systematic framework that would emerge much later. Roman taxation generated immense accounting requirements. The empire was too large for direct tax collection by government employees, so Rome relied on publicani, tax farmers, who bid for the right to collect taxes in a particular province. The publicanus would pay a lump sum to the Roman treasury up front, then collect taxes from the province, keeping the difference between what he collected and what he had paid as his profit. This system was prone to abuse. Tax farmers had strong incentives to extract as much as possible, but it was administratively simple and generated reliable revenue for Rome. The publicani formed themselves into societates, partnerships or corporations that pooled capital to bid on major tax contracts. These societates maintained elaborate accounts, tracking the initial investment, the amounts collected, the expenses of collection, and the distribution of profits among the partners. We have fragments of their accounting records, and they show a sophisticated understanding of partnership accounting, of capital contributions and profit distributions, of accrual and expense matching. For large public works projects, aqueducts, roads, temples, amphitheatres, Rome developed detailed cost accounting. Before beginning a project, officials would prepare an estimate. So much for stone, so much for timber, so much for labour, so much for tools and equipment. As the project proceeded, actual expenditures were recorded and compared to estimates. This allowed administrators to track whether projects were on budget, whether contractors were performing honestly, whether resources were being used efficiently. The Diocletian Price Edict, issued in the year 301 of the Common Era, provides a fascinating window into Roman economic organisation. Facing rampant inflation, the Emperor Diocletian attempted to control prices throughout the empire by decree. The edict lists maximum prices for over 1,000 goods and services: wheat and wine, beef and bacon, silk and wool, carpenters and scribes, teachers and lawyers. The very existence of such a list implies an accounting infrastructure capable of tracking prices across the empire, of gathering information from markets thousands of miles apart, of attempting to regulate commerce through centralized data collection. The edict also specifies the maximum wage for an accountant, a scriba, at 25 denarii per day for someone keeping accounts from dictation, and 50 denarii per day for someone actually preparing accounts. This tells us that accounting was a recognized profession, that there were gradations of skill and responsibility, that it commanded respectable compensation. The Roman economy needed accountants, lots of them, to keep track of everything. Roman military accounting was particularly sophisticated, out of necessity. Legions needed to be paid regularly, or they would mutiny. They needed to be fed and equipped. Supply lines stretched hundreds or thousands of miles. Each legion maintained detailed records of soldiers on the rolls, casualties and transfers, pay owed and pay distributed, supplies on hand and supplies needed. The prefect in charge of a legion's administration was responsible for ensuring these accounts balanced, that soldiers received what they were owed, that the legion could sustain itself. We have papyrus fragments from Roman Egypt showing military pay records. Each soldier's account was tracked individually. Name, unit, basic pay, deductions for food and equipment, bonuses for special service, the net amount paid out. The records are meticulous, almost obsessive in their detail. The Roman army couldn't function without this accounting infrastructure. An empire built on military conquest required military administration, and military administration required accounting. For wealthy Romans, accounting wasn't just about tracking wealth, but also about demonstrating status and probity. A Roman senator was expected to maintain dignitas, a reputation for dignity and honour. Part of that reputation involved being seen as a careful manager of resources, someone whose accounts were in order, who paid debts promptly, who honoured financial obligations. The public nature of Roman life meant that financial misconduct could quickly become political scandal. Cicero, the great Roman orator and statesman, mentioned accounting in several of his speeches and letters. In prosecuting Verres for corruption as governor of Sicily, Cicero demanded to see the accounts, to examine the records of what Verres had collected in taxes and what he had remitted to Rome. The discrepancy, Cicero argued, proved systematic theft. Accounting records were evidence, were proof, could make or break political careers. The Romans also developed an understanding of what we might call fiscal responsibility, though their approach differed from modern notions. The Roman state generally aimed to balance its budget to avoid long-term debt. During the Republic, extraordinary expenses like wars were often funded through special taxes or through looting conquered territories. The accounting distinction between regular revenue and extraordinary income was important. You couldn't rely on conquest plunder forever, so regular expenses needed to be covered by regular revenue. When the Republic gave way to empire under Augustus, accounting became even more centralized and systematic. Augustus himself composed a document called the Res Gestae Divi Augusti, quote 3, which included detailed financial accounting of his expenditures on public works, games, military bonuses, and grain distributions. The document was both propaganda and accounting, showing Augustus as a generous benefactor while also demonstrating his meticulous attention to detail. He knew exactly what he had spent, down to the last sestertius, and wanted everyone else to know too. The Romans understood the concept of the fisces, the imperial treasury that belonged personally to the emperor, as opposed to the aerarium, which theoretically belonged to the Roman people. This distinction created parallel accounting systems, each tracking different flows of money. The fiscus grew increasingly important over the centuries as the emperors accumulated more personal wealth and took on more direct responsibility for administration. Both treasuries maintained elaborate records, employed numerous accountants and clerks, and generated vast archives of financial documentation. Now, let's shift our attention eastward. To the other great empire of this period, Persia under the Sassanid dynasty. The Sassanid Empire, which lasted from approximately 224 to 651 of the Common Era, controlled Mesopotamia, the ancient heartland of accounting, along with Persia proper and territories stretching into Central Asia. The Sassanids inherited the administrative traditions of earlier Persian empires, but they systematized and formalized these traditions in ways that would profoundly influence the later Islamic world. The Sassanid administrative system was built around the concept of the Diwan, a word that originally meant a collection of written documents but came to mean an administrative department or bureau. The most important was the Diwan al-Kharaj, the Department of Land Tax. The Sassanids conducted regular land surveys, measuring agricultural land and assessing its productive capacity. Each plot of land was recorded with remarkable precision. Its size, its soil quality, what crops it produced, what tax it owed. This required an enormous accounting apparatus. Scribes travelled to villages recording information. Calculations were performed to determine fair tax assessments. Records were maintained of who had paid and who still owed. The system was comprehensive and, by the standards of the time, quite equitable. Tax was based on actual productivity rather than arbitrary extraction, but it only worked because of systematic accounting. The Sassanids used a decimal system for numbers, making calculations simpler than in the Roman system with its cumbersome Roman numerals. They also developed sophisticated methods for converting between different currencies, because the empire's vastness meant multiple monetary systems operated simultaneously. Merchants trading from Syria to India needed to convert between Persian silver dirhams, Roman gold solidi, and Indian gold dinars. Accountants specialized in these conversions, maintaining tables of exchange rates, calculating fair values. The Sassanid Empire also supported an extensive network of royal roads and caravanserais, rest stops for merchants. These were in part commercial infrastructure, but also instruments of control and taxation. Goods moving along the roads were taxed at various points, and these taxes had to be accounted for. The state maintained records of trade flows, of customs revenues, of the goods moving through the empire. This information was valuable not just fiscally but also strategically. Knowing what goods were scarce, what goods were abundant, allowed the state to respond to economic conditions. When the Byzantine Empire, the eastern continuation of Rome, faced off against the Sassanid Empire, both relied heavily on their administrative and accounting systems. Wars were expensive, requiring money to pay soldiers, to build fortifications, to sustain campaigns. Both empires taxed their populations heavily, and both maintained records of tax collection and expenditure. In some ways, these wars were contests of administrative efficiency as much as military prowess. Whichever empire could better extract resources from its population and deploy them effectively would prevail. Byzantium inherited Rome's accounting traditions, but adapted them to changing circumstances. Greek became the language of administration, replacing Latin. The Roman systems of tabulae and codices continued but were modified. Byzantine tax collection was ruthlessly systematic, with detailed cadastral surveys, records of land ownership and tax liability, maintained for the entire empire. These surveys were periodically updated, ensuring the state's information remained current. Byzantine monasteries also maintained elaborate accounts, recording donations received, expenses for maintaining monks and buildings, income from monastic estates. Monasteries accumulated significant wealth and needed accounting systems to manage it. The monastic accounting records that survive show careful tracking of assets, revenues, and expenditures, demonstrating that religious institutions faced the same practical necessities as secular ones. As the 7th century approached, both the Byzantine and Sassanid empires were exhausted from decades of warfare. Their administrative systems remained sophisticated, their accounting methods well developed, but the empires themselves were vulnerable. Into this world would come a new force, emerging from the Arabian Peninsula, bringing a new religion and new energy. But the Muslims who conquered these ancient empires would inherit their administrative systems, including their accounting methods. The Diwan of the Sassanids would become the Diwan of the Islamic caliphates. The careful record-keeping of Byzantium would influence Islamic administration. Let's pause here and consider what this means. Accounting systems don't emerge from abstract reasoning. They emerge from practical necessity, from the needs of complex societies to track resources and obligations. The Romans needed accounting because their empire was vast and diverse. The Sassanids needed accounting because systematic taxation required systematic record-keeping. Byzantium needed accounting because without it, the apparatus of empire would collapse into chaos. Each civilization developed methods suited to its particular circumstances, but certain principles emerged again and again. Transactions must be recorded. Records must be organized systematically. Accounts must be regularly reviewed and reconciled. Trust in economic relationships requires documentary evidence. These principles, discovered and rediscovered across cultures and centuries, were part of the inheritance that the early Islamic world would receive. The clay tablets of Mesopotamia, the wax tablets of Rome, the papyrus scrolls of Egypt, the parchment codices of Byzantium, the land surveys of Sassanid Persia. These were all variations on a theme, different expressions of the same fundamental human need to remember, to account for, to organize economic complexity. The specific techniques varied, the underlying logic remained constant. As night falls across the Mediterranean and across Mesopotamia, As scribes in Constantinople and Ctesiphon complete their day's work and file their records away, the stage is set for the next act in our story. The inheritance is prepared. The administrative knowledge accumulated over millennia is ready to be passed on. Soon, a new civilization will arise that will not only preserve this knowledge but build upon it, creating accounting methods that will eventually reshape the world. But for now, let that image rest. Clerks and scribes across the ancient world, from Rome to Persia, patiently recording transactions, maintaining accounts, building the systems that allow empires to function and trade to flourish, doing the quiet, unglamorous work that makes civilization possible. The empires of Rome and Persia were ancient, their administrative systems refined over centuries, their accounting methods sophisticated and well established. But in the early 7th century of the Common Era, in the Arabian Peninsula, something new was beginning, something that would eventually transform not just the political map, but also the economic and intellectual landscape of half the world. And at the heart of this transformation was a man who, before he became a prophet, was a merchant. Let's travel now to Mecca around the year 590 of the Common Era. The city sits in a valley in the Hejaz region of Arabia, not particularly fertile, not blessed with great natural resources, but positioned at a crucial crossroads. Trade routes from Yemen carrying frankincense and myrrh, from India bringing spices and textiles, from Syria carrying manufactured goods and grain, all these routes converged on Mecca. The city had become wealthy, not from what it produced but from what passed through it, from the caravan trade that connected the Indian Ocean world with the Mediterranean. The society of pre-Islamic Arabia, what Muslims would later call the Jahiliyyah or Age of Ignorance, was organized around tribes and clans. The Quraysh tribe controlled Mecca and dominated its trade. Within the Quraysh, certain families were particularly wealthy and influential, operating what we might think of as trading companies or merchant houses. These weren't corporations in the modern sense, but they were organized commercial enterprises, pooling capital from multiple investors to fund trading expeditions, sharing profits according to agreed-upon formulas, maintaining accounts of investments and returns. Commercial culture in Mecca was sophisticated. Merchants understood credit and debt, partnership and profit sharing, risk and insurance. When a caravan left Mecca bound for Syria, it might carry goods belonging to dozens of different investors, each of whom had contributed capital and expected a share of profits. The caravan leader had to keep careful track of whose goods were whose, what sold for what price, what expenses were incurred along the way, how profits should be distributed upon return. This required accounting, required record-keeping, required trust backed by documentation. Into this commercial world was born Muhammad ibn Abdullah around the year 570. His father died before he was born. His mother died when he was 6. He was raised by his grandfather and then his uncle, members of a respected clan within the Quraysh but not among the wealthiest. As a young man, Muhammad worked in the caravan trade, first as a shepherd. Tending flocks was common apprenticeship for young men, and then as a commercial agent for wealthy merchants. His reputation was sterling. People called him Al-Amin, the trustworthy one. In a society where trade depended on trust, where a merchant sending goods with a caravan had to trust that the agent wouldn't steal or cheat, where investors had to trust that profits would be honestly calculated and fairly distributed, trustworthiness was the most valuable quality a person could possess. Muhammad's reliability made him valuable to the merchant families of Mecca. One of the wealthiest of these merchants was a woman named Khadija bint Khuwaylid. She was a widow who had inherited and expanded her late husband's trading business. Women in pre-Islamic Arabia could own property, conduct business, and accumulate wealth in their own right, though the society was still patriarchal in many ways. Khadija needed reliable agents to lead her caravans to Syria and back. She hired Muhammad, impressed by his reputation. The arrangement was a form of mudaraba, a profit-sharing partnership where one party provides capital and another provides labour and expertise. Khadija would provide the trade goods and finance the expedition. Muhammad would travel with the caravan, make the business decisions, sell goods in Syria, purchase goods to bring back. Upon return, profits would be split according to a pre-agreed ratio. This type of partnership was common in the Arabian trading world and would later be formalized in Islamic commercial law. Muhammad proved exceptionally capable. The caravans he led for Khadija were profitable. His honesty was absolute. He accounted for every dirham, every transaction, every expense. In a world where agents could easily embezzle or claim expenses that were never incurred, his scrupulous accounting stood out. Khadija was impressed, and their relationship evolved from commercial to personal. Despite being 15 years older than Muhammad and his employer, she proposed marriage. He accepted. She would become not just his wife, but his closest companion, his supporter, the mother of his children. For the next 15 years or so, Muhammad lived as a merchant, managing Khadija's trading business, raising a family, earning respect in Meccan society. This period is important for understanding what came later. When Muhammad began receiving revelations around the year 610, when he began preaching the message that would become Islam, he wasn't an unworldly mystic detached from practical life. He was a merchant, a businessman, someone who understood commerce and contracts, credit and debt, the importance of honest dealing and clear accounting. The Quran, the holy book of Islam that Muslims believe contains God's revelation to Muhammad, is filled with commercial and economic language. This makes sense given Muhammad's background and the commercial culture of Mecca, but it's still striking how much attention the text pays to economic matters. There are detailed rules about contracts and witnesses, about weights and measures, about debts and their repayment, about charity and its calculation, about inheritance and its division. One of the longest verses in the Quran, verse 282 of the second chapter, deals entirely with commercial documentation. It instructs believers who enter into a debt contract to write it down, to have it witnessed, to specify the terms clearly. Neither scribe nor witness should refuse to perform this service when called upon. The verse emphasizes the importance of documentation, of creating clear records, of having independent verification of agreements. It's essentially a command to maintain proper accounting. The verse says, when you contract a debt for a fixed period, write it down. Let a scribe write it down between you and justice. Let no scribe refuse to write as God has taught him, so let him write. Let the one who incurs the debt dictate, and let him fear God his Lord and not diminish from it anything. If the one who incurs the debt is of a limited understanding or weak or unable to dictate himself, then let his guardian dictate in justice, and bring to witness 2 witnesses from among your men, and if there are not 2 men available, then a man and 2 women from those you accept as witnesses, so that if one of them errs, the other can remind her. And let the witnesses not refuse when they are called upon. Do not be too weary to write it, whether it is small or large, for its specified term. That is more just in the sight of God and stronger as evidence and more likely to prevent doubt between you. This is remarkable specificity for a religious text. It's treating commercial documentation as a religious obligation, as something that matters to God, not just to merchants. The emphasis on writing things down, on having witnesses, on being precise about terms, these are accounting principles being enshrined in Scripture. The Quran also introduces concepts that would profoundly shape Islamic economic life, and therefore Islamic accounting. One is the prohibition of riba, usually translated as usury or interest. The Quranic verses on riba are emphatic. Those who consume interest will not stand on the day of resurrection, except as one stands who is being beaten by Satan into insanity. That is because they say trade is just like interest, but God has permitted trade and has forbidden interest. The prohibition of riba created a fundamental challenge. How do you have a functioning economy with credit and investment and time value of money without interest? The answer would be various forms of profit sharing and equity-based financing, which in turn created accounting challenges. If a loan can't charge fixed interest but can share in profits, you need very careful accounting of what the profits actually are. Both investor and entrepreneur need to trust that profits are being calculated honestly, that expenses are legitimate, that revenue is fully reported. Islamic law would develop several contract forms that avoided interest while still allowing commerce to flourish. The mudaraba we mentioned earlier, where one party provides capital and another provides labour. With profits shared according to pre-agreed ratios. The musharaka, a partnership where multiple parties contribute capital and share both profits and losses. The murabaha, a cost plus sale where a seller discloses their cost and adds a markup, allowing the buyer to verify the fairness of the price. Each of these required clear accounting, required documentation, required trust verified through records. Another transformative Quranic principle was zakat, the obligatory charity that became one of the 5 pillars of Islam. Zakat isn't a voluntary donation but a religious obligation, a form of wealth tax. The Quran specifies that Muslims with sufficient wealth must give a portion to support the poor, to free slaves, to help those in debt, to support travellers, and for other specified purposes. The calculation of zakat is complex and requires accounting. The basic rate is 2.5% of wealth held for a full lunar year, but what counts as wealth subject to zakat? Livestock. Yes, above certain minimums. Gold and silver and trade goods? Yes. Agricultural produce? Yes, at different rates depending on whether the land is irrigated or rain-fed. But not personal possessions for one's own use, not one's residence, not tools of one's trade. To calculate zakat correctly, a Muslim needed to know exactly what they owned, to distinguish between different categories of assets, to track whether wealth had been held for a full year. This created an accounting obligation. Wealthy Muslims needed to maintain records of their assets to calculate zakat accurately. For merchants, this meant tracking inventory, receivables, cash. For farmers, it meant knowing how much produce was harvested. For herders, it meant counting livestock. The religious obligation to pay zakat created a practical necessity for accounting. Islamic inheritance law added another layer of accounting necessity. The Quran specifies detailed rules for how estates should be divided among heirs. Sons receive certain shares, daughters receive certain shares, parents receive shares, spouses receive shares. And the exact fractions depend on which relatives survive and in what configuration. A man with 3 daughters and parents but no sons would divide his estate differently than a man with 2 sons and a daughter but no surviving parents. These fractional divisions could become quite complex. Working out exactly what each heir should receive required mathematical skill and careful accounting. The deceased's assets had to be tallied precisely. Debts had to be paid first before dividing the remainder. Specific bequests up to 1/3 of the estate were allowed. Then the remaining estate was divided according to the Quranic formulas. This wasn't approximate division, but precise mathematical calculation, requiring knowledge of fractions and facility with computation. The early Muslim community in Medina, after Muhammad and his followers emigrated there from Mecca in the year 622, needed to organize community finances. The Constitution of Medina, a document establishing the rights and responsibilities of the Muslim community and the allied tribes, included provisions about mutual financial obligations. The community maintained a treasury, the Bayt al-Mal, which collected zakat and other revenues and distributed them for specified purposes. The Bayt al-Mal required administration and accounting. Someone had to track what was collected and from whom, what was distributed and to whom what remained in the treasury. The Caliph Umar, who ruled from 634 to 644, was particularly known for his administrative rigour. He established registers, diwans, to track warriors entitled to stipends from the Bayt al-Mal, to record land ownership and tax obligations, to maintain accounts of revenue and expenditure, Umar also introduced the Islamic calendar, a lunar calendar beginning with Muhammad's emigration to Medina. Having a standard calendar was essential for accounting. Contracts needed dates, obligations needed terms, zakat calculations required knowing when a full year had passed. The Islamic calendar, with its 12 lunar months totaling 354 or 355 days, meant years shifted relative to the solar calendar, which created complexities for agricultural taxation, but it provided a standard chronological framework. The early Muslim community was conscious of the need for fair weights and measures. The Quran repeatedly condemns those who give short measure or underweight, who cheat in transactions through dishonest measurement. In pre-Islamic Arabia, each town might have different standards, making trade complicated and creating opportunities for fraud. Islamic authorities worked to standardize measures, at least within their realm, and to enforce honest weighing and measuring in markets. The office of the Muhtasib, the market inspector, emerged partly to enforce these standards. The Muhtasib would check weights and measures, verify that merchants weren't adulterating goods or engaging in fraud, ensure that prices were fair and transactions honest. This required the Muhtasib to have knowledge of accounting, to be able to spot irregularities in merchants' practices, to understand what fair pricing meant in different commodities. Islamic law also developed detailed rules about witnesses and testimony in commercial disputes. A contract wasn't just a private agreement, but a matter of legal evidence. The requirement for witnesses, for written documentation, for clear specification of terms, all this created a culture where accounting mattered, where records were taken seriously, where documentation was expected. Consider the practice of partnership, which was common in Islamic commerce. Two or more merchants might pool resources to fund a trading venture. Islamic law specified different types of partnership with different rules about profit sharing, liability, and management rights. But all partnerships required clear accounting. Partners needed to know what capital each had contributed, what expenses had been incurred, what revenue had been earned, how profits should be divided. A partnership without proper accounting was a partnership destined for dispute and dissolution. The prohibition of gharar, excessive uncertainty or ambiguity in contracts, also encouraged clear accounting. A contract where terms were vague, where obligations were uncertain, where outcomes were unclear, was considered problematic in Islamic law. This pushed toward greater specificity, toward clearer documentation, toward better record keeping. If you were selling goods for future delivery, the quantity and quality had to be specified exactly. If you were entering a partnership, the terms had to be clear. Ambiguity was not just poor practice, but religiously problematic. All of these principles and practices, the prohibition of interest, the obligation of zakat, the complexity of inheritance, the emphasis on documentation and witnesses, the standardization of weights and measures, the rules about partnership and contracts, created an environment where accounting was not just useful but necessary. A pious Muslim merchant needed to account accurately to fulfill religious obligations. A Muslim judge needed accounting evidence to resolve commercial disputes. A Muslim ruler needed accounting systems to collect taxes and manage the treasury. Muhammad died in the year 632. Having transformed Arabia and set in motion a movement that would transform the world. Within decades, Muslim armies had conquered the Sassanid Persian Empire entirely and taken substantial territory from the Byzantine Empire. Egypt, Syria, Mesopotamia, Persia, all came under Muslim rule. The Muslims didn't destroy the administrative systems they found, but adapted and adopted them. The Persian Diwan system became the Islamic Diwan system. The land tax records maintained by the Sassanids were updated and continued. The Byzantine methods of census and taxation were preserved, where Muslims ruled former Byzantine territories. But now these administrative systems operated within an Islamic framework, guided by Islamic legal principles, serving Islamic religious and political purposes. the early Muslim state needed accountants, lots of them. The vast territories under Muslim rule required taxation, and taxation required systematic record-keeping. The distribution of stipends to warriors and their families required registries tracking who was entitled to what. The collection and distribution of zakat required knowing who should pay and who should receive. All of this created demand for people skilled in calculation and record-keeping. Initially, much of this work was done by non-Muslims, Christians and Jews and Zoroastrians, who had experience with administration under the previous empires. The early Muslim rulers pragmatically employed whoever had the skills they needed. But over time, Muslims themselves became trained in these arts. Accounting wasn't a separate discipline yet, but part of the general knowledge expected of an administrator, a merchant, a judge, anyone involved in economic life. The Arabic language itself was adapted to these needs. Arabic is a Semitic language, related to Hebrew and Aramaic, with its own logic and structure. It acquired new vocabulary for commercial and administrative purposes, sometimes borrowing from Persian or Greek, sometimes creating new terms from Arabic roots. The word for accounting, muhasaba, comes from the root hsb, meaning to count or reckon. The same root gives us hisab, calculation or arithmetic. Language and practice evolved together. By the end of the 7th century, the Islamic world stretched from Spain to the borders of India. It encompassed diverse peoples, languages and traditions, but it was unified by religion, by political allegiance to the caliphate, and increasingly by shared administrative and commercial practices. The accounting methods developed to serve Islamic religious obligations and Islamic commercial law were spreading across this vast realm, carried by merchants and administrators, by judges and tax collectors, by everyone who needed to track wealth and obligations in this new Islamic order. Let's pause and consider what had been established. Islam as a religion gave special importance to commercial honesty, to clear documentation, to mathematical precision in matters of charity and inheritance. Islamic law developed detailed rules about contracts and partnerships that required careful accounting. The Islamic state inherited sophisticated administrative systems from the empires it conquered and adapted them to Islamic purposes. And the Islamic world was becoming a vast integrated commercial zone where trade flourished and accounting was essential. The stage was set for the next development, the one that would truly transform the practice of accounting. The Abbasid Revolution, the founding of Baghdad, the translation movement, the House of Wisdom, and the synthesis of Greek mathematics, Indian numerals, Persian administration, and Islamic law into something new and powerful. But that synthesis hadn't happened yet. In the year 700, as the first century of Islamic history drew to a close, the foundations were laid, the pieces were in place, the potential was there. What would be built on these foundations would astonish the world, but for now let that potential rest, quietly gathering, like seeds in dark earth waiting for spring. The seeds planted in the first century of Islam, the emphasis on documentation, the obligation of zakat requiring precise calculation, the prohibition of interest creating new forms of partnership and finance, were about to bear extraordinary fruit. The year 750 of the Common Era marked a revolution, not just political, but intellectual, administrative, cultural. The Umayyad Caliphate, which had ruled the Islamic world from Damascus, fell to a rebellion led by the Abbasid family, descendants of Muhammad's uncle. And with this change in dynasty came a shift in the very centre of Islamic civilization, a shift that would create the conditions for accounting to evolve from practical necessity into something approaching science. The Abbasids moved the capital eastward, away from the Mediterranean world that had been Rome's domain, toward the ancient heartland of Mesopotamia. In 762, the second Abbasid caliph, al-Mansur, founded a new city on the western bank of the Tigris River. He called it Madinat al-Salam, the city of peace, but the world would know it as Baghdad. The location was chosen carefully. It sat near the ruins of ancient Babylon and Ctesiphon. inheriting the prestige and strategic position of those ancient capitals. It was at the crossroads of trade routes running east to west, north to south. Rivers and canals connected it to the Persian Gulf and the Indian Ocean beyond, and the land was fertile, watered by the Tigris and Euphrates, capable of supporting a large population. Al-Mansur designed Baghdad as a circular city, a perfect geometric form that reflected Islamic aesthetics and practical urban planning. At the centre stood the Caliph's palace and the Great Mosque. Radiating outward were streets and buildings, markets and neighbourhoods, all organised with careful attention to function and beauty. The city grew rapidly. Within a generation, Baghdad had become the largest city in the world outside China, home to perhaps 500,000 people. A cosmopolitan metropolis where Arabs and Persians, Turks and Indians, Christians and Jews and Zoroastrians lived and worked and traded. The Abbasid court attracted talent from across the Islamic world and beyond. Scholars, poets, musicians, physicians, astronomers, mathematicians, anyone with skill or knowledge could find patronage in Baghdad. The caliphs, especially Harun al-Rashid, who ruled from 786 to 809, and his son al-Ma'mun, who ruled from 813 to 833, took conscious pride in supporting learning. This wasn't just decorative patronage, but genuine intellectual engagement. Al-Ma'mun in particular was known for his own interest in philosophy and science, for participating in scholarly discussions, for making the support of learning a central part of his reign. The institutional expression of this support was the Bayt al-Hikma, the House of Wisdom, established in Baghdad during al-Ma'mun's reign. The exact founding date is uncertain, perhaps around 830, but the institution itself became legendary. It was part library, part translation bureau, part research institute. Scholars gathered there to translate texts from Greek, Persian, Sanskrit and other languages into Arabic. Manuscripts were collected from across the known world, sometimes through purchase, sometimes as tribute, sometimes through diplomatic exchange. The goal was nothing less than to gather the accumulated knowledge of human civilization and make it available in Arabic. The translation movement that centered on the House of Wisdom was one of the great intellectual enterprises in human history. Greek philosophical and scientific texts that had been lost or forgotten in Europe were preserved in Arabic translation. Aristotle and Plato, Euclid and Ptolemy, Galen and Hippocrates, their works were translated. Studied, commented upon, and integrated into Islamic intellectual life. Persian texts on administration and statecraft, on medicine and astronomy, were translated and absorbed. Indian mathematical and astronomical works were translated, bringing knowledge of the decimal place value system and the concept of zero. Let's think about what this meant for accounting. Translations of Greek mathematical texts made available the geometric and arithmetic knowledge of antiquity. Euclid's Elements provided rigorous logical foundations for mathematical reasoning. Diophantus's Arithmetica offered methods for solving problems involving unknown quantities. These texts weren't just theoretical abstractions, but tools that could be applied to practical problems, including commercial and administrative calculations. Even more important were the Indian mathematical works translated into Arabic. A Sanskrit astronomical text called the Sindind was translated in the late 8th century. It included not just astronomy but also computational methods, and crucially it introduced the Indian system of numerals, the symbols we now call Arabic numerals, though the Arabs themselves called them Indian numerals, properly crediting their origin. The Indian numeral system was revolutionary for several reasons. First, it used position value. The same symbol means different things depending on where it appears. The numeral 3 means 3 if it's in the ones place, but 30 if it's in the tens place, 300 if it's in the hundreds place. This seems obvious to us because we learned it as children, but it was a profound conceptual breakthrough. Earlier systems like Roman numerals didn't work this way. In Roman numerals, 10 is x, no matter where it appears. This makes arithmetic cumbersome, Try multiplying large numbers in Roman numerals and you'll appreciate the difficulty. Second, the Indian system included 0, represented by a symbol, allowing place value to work consistently. 0 wasn't just absence of quantity, but a number in its own right, a placeholder that allowed you to distinguish between 3 and 30 and 300. This concept was difficult for some cultures to grasp. How can nothing be something? But it was essential for efficient calculation. Third, the Indian numerals, once you learned them, made calculation far easier than previous methods: addition, subtraction, multiplication, division, all became mechanical procedures that could be taught systematically. You didn't need an abacus or counting board. You could calculate with pen and paper, writing out the steps, checking your work, teaching others the method. The scholar most associated with introducing these numerals and methods to the Islamic world was Muhammad ibn Musa al-Khwarizmi. His very name would become a word in European languages. Algorithm, meaning a step-by-step procedure for calculation, comes from Al-Khwarizmi. He worked in the House of Wisdom during Al-Mamun's reign, and wrote several influential mathematical works. His book on the calculation with Hindu numerals, written around 825, explained the Indian numeral system and showed how to use it for arithmetic. The book was later translated into Latin, and it was through this Latin translation that Europe would eventually learn about these numerals, which they called Arabic numerals, not knowing they had originated in India. Al-Khwarizmi's clear explanations and systematic methods made the new numerals accessible to merchants and accountants as well as mathematicians. But Al-Khwarizmi's most influential work was the compendious book on calculation by completion and balancing, written around 820. This book gave the world the word and concept of algebra, from the Arabic al-jaba, meaning completion or restoration. Al-Khwarizmi presented systematic methods for solving problems involving unknown quantities. He classified problems into types and showed general solutions for each type. Many of his example problems had practical commercial applications, dividing estates according to Islamic inheritance law, calculating profits from trading ventures, determining fair divisions of property. Consider a typical problem from Al-Khwarizmi's algebra book. A man dies leaving sons and daughters. The sons are to receive twice the share of daughters according to Islamic law. The estate is worth a certain amount. How much does each child receive? Al-Khwarizmi showed how to set up the problem algebraically, to represent unknown quantities with symbols, to manipulate these symbols according to systematic rules, and to arrive at the solution. This was more than arithmetic. It was abstract reasoning about quantities, but applied to concrete practical problems. For accounting, this mattered enormously. Accountants constantly face problems requiring calculation, converting between currencies at varying exchange rates, calculating profits when goods were bought and sold at different prices in different quantities, determining fair shares when partnerships were dissolved, computing zakat on complex portfolios of assets. The algebraic methods Al-Khwarizmi developed provided systematic procedures for solving these problems, rather than relying on trial and error or rules of thumb. The House of Wisdom attracted scholars from diverse backgrounds. Hunayn ibn Ishaq, a Christian from Hira, became perhaps the greatest translator of the age, rendering scores of Greek medical and philosophical texts into Arabic, often via intermediate Syriac translations. His work wasn't just literal translation, but careful scholarly interpretation, choosing the best manuscripts, comparing different versions, adding commentary to clarify difficult passages. The translations produced at the House of Wisdom were serious scholarly works, not just rough renderings of foreign texts. The Abbasid administration itself was a marvel of organisation, building on Persian and Byzantine precedents, but exceeding them in scale and complexity. The Diwan al-Kharaj, the land tax department, maintained records for the entire empire, from Spain to Central Asia. Each province had its own tax registers, recording land holdings, tax assessments, payments made, and arrears owed. These provincial records were summarized and sent to Baghdad, where central administration could track revenue from across the empire. The position of wazir, or vizier, the chief minister who managed administration on behalf of the caliph, became institutionalized under the Abbasids. The wazir oversaw the various diwans, coordinated policy and reported to the caliph. Some wazirs, like the members of the Barmakid family who served Harun al-Rashid, were extraordinarily powerful, essentially running the empire on a day-to-day basis. The Barmakids were originally Persian Buddhists who had converted to Islam, bringing with them Persian administrative expertise. They reformed and systematized the tax administration, improved record-keeping, and ensured that revenue flowed efficiently to Baghdad. Baghdad's markets were legendary. The city had specialized souks for different trades and goods, a book market where manuscripts were bought and sold, a spice market fragrant with cinnamon and cardamom, a textile market displaying silk from China and linen from Egypt, a copper market where craftsmen hammered vessels and decorations. Each market had its own customs and regulations. Merchants kept records of their inventory and transactions. Money changers operated stalls where different currencies could be exchanged, maintaining ledgers of exchange rates that fluctuated based on supply and demand. The use of Hindu-Arabic numerals spread among merchants and accountants in Baghdad and gradually throughout the Islamic world. At first, traditional methods persisted. Some accountants continued using finger reckoning, a system where complex calculations could be performed using finger positions or counting boards similar to the abacus. But the advantages of the new numerals became increasingly apparent. Calculations could be written down, checked, preserved as records. Errors could be spotted and corrected. Methods could be standardized and taught. The word for zero in Arabic, sifr, meaning empty or vacant, would give rise to the word cipher in European languages and eventually to zero itself. The concept was difficult initially. How could nothing be represented by something? What did it mean to have 0 sheep or 0 dinars? But in accounting contexts, the meaning became clearer. 0 represented the balance when assets equaled liabilities, when income equaled expenses, when what you owned exactly matched what you owed. 0 was equilibrium. The point of resolution. Al-Mamun encouraged not just translation but original research. He established an observatory in Baghdad where astronomers could make precise measurements of celestial positions. Astronomy and accounting might seem unrelated, but both required mathematical precision, both involved careful record-keeping, both benefited from better computational methods. The astronomical tables produced in Baghdad required vast amounts of calculation, tracking planetary positions over years and decades, predicting eclipses, determining the times for Islamic prayers which varied by location and season. All this calculation refined mathematical techniques that could then be applied to other domains. The Caliph himself reportedly participated in mathematical discussions. One story, perhaps apocryphal but revealing nonetheless, tells of Al-Mamun dreaming of Aristotle, who appeared to him and encouraged the pursuit of knowledge. Whether or not the dream occurred, it captured something true about Al-Mamun's reign, a genuine commitment to learning, a belief that knowledge was valuable for its own sake as well as for practical application, a willingness to support scholarship generously. The translation movement wasn't just one-directional. From ancient languages into Arabic, it also involved synthesizing different traditions, seeing connections between Greek geometry and Indian arithmetic, between Persian administrative practice and Islamic legal requirements, between philosophical reasoning and practical problem-solving. Scholars at the House of Wisdom weren't just preserving old knowledge but creating something new from diverse sources. For accounting specifically, this synthesis meant combining elements from different traditions into more sophisticated methods. The Persian Diwan system provided organizational structure for government accounting. Islamic law provided religious and legal framework for commercial accounting. Greek mathematics provided logical rigor for calculation. Indian numerals provided efficient computational tools. All these elements were coming together in Baghdad in the 9th century, creating the conditions for accounting to advance beyond anything that had existed before. The city itself was a character in this story. Baghdad's cosmopolitanism meant that ideas flowed freely, that merchants from distant lands brought not just goods, but information, that scholars from different backgrounds worked side by side, that innovation was possible because diverse perspectives encountered each other daily. A Jewish merchant from Egypt might discuss business practices with a Muslim merchant from Persia and a Christian merchant from Syria, each learning from the others, each adapting methods from different traditions. The physical infrastructure of Baghdad supported this commercial and intellectual activity. The Tigris River allowed goods to be transported by boat. Bridges connected the two banks of the river. Canals brought water to different quarters of the city. The round city, Al-Mansur's original foundation, had been supplemented by new quarters on both sides of the river, each with its own markets and mosques and baths. The city was growing organically, beyond the geometric perfection of its original design, becoming more complex and vital. At night, Baghdad must have been remarkable. Oil lamps and candles lit the markets and wealthy homes. The palace complex was illuminated for celebrations and receptions. The House of Wisdom would have been quieter after dark, but not empty. Scholars working late, copying manuscripts by lamplight, checking calculations, discussing ideas. The work of scholarship was patient and painstaking, requiring long hours of concentration, careful attention to detail, willingness to revise and refine. Think of a copyist in the House of Wisdom, reproducing a Greek mathematical text that had been translated into Arabic. Each symbol must be formed precisely. Each line of reasoning must be copied accurately. A single error could corrupt the text, could lead future readers astray. The work required intense focus but also deep understanding. You couldn't copy what you didn't comprehend. The best copyists were also scholars, able to spot errors in the text they were copying, to compare different manuscript versions, to add marginal notes clarifying difficult passages. Or think of an accountant in the tax administration, recording payments received from a distant province. The amounts must be converted from local currency to the standard accounting unit. The conversion rate must be recorded. The payment must be credited to the correct account. The balance must be recalculated. Everything must be written clearly enough that another accountant could review the work months or years later and understand what had been done. This was memory. This was organization. This was the work that allowed empire to function. The reign of Al-Mamun ended in 833 when he died during a military campaign. His successors continued to patronize learning, though perhaps with less personal enthusiasm. The House of Wisdom continued to function, the translation movement continued, scholarship continued. But something about Al-Mamun's reign marked a peak, a moment when political power and intellectual ambition aligned, when resources flowed toward knowledge, when Baghdad truly was the center of the learned world. The advances made during this period, the adoption of Hindu-Arabic numerals, the development of algebra, the synthesis of mathematical knowledge from different traditions, the systematization of accounting methods, would persist and spread. Scholars in Baghdad trained students who carried their knowledge to other cities. Merchants who learned new calculation methods in Baghdad's markets brought them to Egypt and Syria and Persia. Administrative reforms pioneered in the Abbasid Diwans were copied by provincial governors and eventually by other dynasties. Let's pause here and reflect on what had been created. The Abbasid revolution had moved Islam's political centre to Mesopotamia, to the ancient land where accounting had first been born in clay tablets millennia earlier. Baghdad had become a city of unparalleled wealth and learning, a place where knowledge from across the known world was gathered and synthesized. The House of Wisdom had institutionalized the pursuit of learning, creating space for translation and research, for preservation and innovation. And the mathematical tools essential for sophisticated accounting, positional numerals, zero, algebra, had been introduced and were beginning to transform practice. This wasn't yet the full flowering of Islamic accounting that would come in subsequent centuries. Methods were still being developed, practices were still being standardized, knowledge was still spreading from centers like Baghdad to the wider Islamic world. But the foundations had been laid, the tools had been created, the intellectual framework had been established. What would be built on these foundations would shape commerce and administration, not just in the Islamic world but eventually across the globe, as these methods spread to Europe and beyond. For now, imagine Baghdad as the 9th century draws to a close. The House of Wisdom stands as a symbol of human curiosity and ambition. The Tigris flows past, carrying boats laden with goods and ideas. In the markets, merchants calculate profits using the new numerals. In the tax offices, administrators record revenues using systematic accounting methods. In the scholars' quarters, mathematicians solve problems and write treatises. Everything is connected. The practical needs of commerce and administration driving intellectual innovation providing better tools for commerce and administration. The city hums with activity, with exchange, with the slow, patient work of building civilization. Let that image settle as we prepare to explore how these tools and methods were actually used. How accounting functioned in the daily life of the Islamic world, how numbers organized complexity and created trust. The scholars in the House of Wisdom developed mathematical theories and translated ancient texts. But accounting isn't primarily an academic discipline. It lives in the marketplace, in the merchant's ledger, in the caravan master's records, in the contracts drawn up between partners embarking on a trading venture. Let's leave the rarefied air of the palace and the scholarly institutes and walk instead through the souks of Baghdad, through the counting houses of Cairo, through the ports where ships from the Indian Ocean world brought spices and textiles, through the practical daily world where accounting was not theory but necessity. A merchant house in 9th century Baghdad might occupy several buildings: warehouse space for storing goods, office space where records were kept and business conducted, living quarters for the merchant's family. The merchant himself, let's imagine his name is Ahmad, deals in textiles. He imports raw silk from Central Asia and Persia, has it woven into fabric in Baghdad or Damascus, then exports finished cloth to Egypt and North Africa, where it commands high prices. His business requires capital, which he doesn't fully possess himself, so he operates through partnerships with investors who provide funds in exchange for shares of profit. Each morning, Ahmad arrives at his office and reviews the previous day's entries in his daybook, his Yawmiya. This is where transactions are first recorded, in the order they occur. Goods received from a weaver, payment made to a dyer, advance given to a caravan leader, deposit received from an investor. The entries are in Arabic, using Hindu-Arabic numerals for amounts. Each entry notes the date according to the Islamic calendar, the parties involved, the nature of the transaction, and the amount. The Yawmiya isn't the final accounting record but a working document, sometimes hastily written, sometimes with corrections and insertions. At regular intervals, perhaps weekly, perhaps monthly, Ahmad or his chief clerk transfers information from the Yawmiya to more organised ledgers. There's a ledger for accounts with individual business partners, showing what each has invested and what profits have been distributed. There's a ledger for inventory, tracking what goods are on hand in the warehouse. There's a ledger for outstanding receivables, money owed to Ahmad by customers who bought on credit. There's a ledger for payables, money Ahmad owes to suppliers and workers. This system of multiple books, of information moving from initial recording to organised accounts, resembles the Roman distinction between adversaria and codex. But the Islamic system is evolving toward something more sophisticated, toward methods that will eventually be recognised as precursors to double-entry bookkeeping. Ahmad doesn't yet make entries in two places for each transaction. doesn't yet balance debits against credits in the systematic way that Luca Pacioli will describe in 15th century Italy. But he understands that every transaction has two sides, that money flowing out from one person flows into another, that assets and claims must ultimately balance. One of Ahmad's major business arrangements is a Mudaraba partnership with a wealthy landowner named Ibrahim. Ibrahim has provided 10,000 dinars of capital. Ahmad will use this money to purchase raw silk, have it processed and woven, and sell the finished cloth. When the venture concludes, perhaps after a year, perhaps after a specific caravan cycle, they will calculate the profit and divide it according to their agreement. Ibrahim as the investor will receive 2/3 of the profit. Ahmad as the working partner will receive 1/3. The Mudaraba structure elegantly avoids the prohibition on riba, on interest. Ibrahim doesn't lend money at a fixed rate of return. Instead, he invests in a commercial venture and shares in whatever profit results. If Ahmad is skillful and fortunate, profits might be substantial, and Ibrahim's return might far exceed what any interest payment would have provided. But if the venture fails, if silk prices collapse or goods are lost or the market shifts, Ibrahim might lose his entire investment. Ahmad, for his part, risks his labour and expertise but not his own capital. He receives nothing if there's no profit. But he also doesn't bear financial loss beyond his wasted time and effort. This arrangement requires meticulous accounting. Ahmad must track every expense related to the Mudaraba. The cost of purchasing silk, the fees paid to weavers and dyers, the wages of warehouse workers, the commission paid to the merchant who sells the finished cloth in Egypt, the transportation costs, the customs duties. All these expenses reduce the profit that will be divided between Ahmad and Ibrahim. Ahmad's own living expenses, his personal purchases, the costs of other business ventures, these must be kept strictly separate. Only the expenses directly related to this specific Mudaraba can be charged against it. Ibrahim has the right to inspect Ahmad's accounts. Islamic law requires the Mudarib, the working partner, to maintain clear records and to provide accounting to the investor. Ibrahim doesn't involve himself in day-to-day management. That would transform the partnership into a different type, a musharaka where both partners participate in management. But he can and does review the books periodically, checking that expenses are legitimate, that revenue is fully recorded, that the profit calculation is honest. The trust required for this arrangement is substantial, but it's trust backed by documentation, by witnesses, by legal enforceability, and by reputation. Ahmad knows that if Ibrahim discovers dishonesty in the accounts, he could take the matter to a qadi, an Islamic judge. The qadi would examine the records, hear testimony from witnesses, and render judgment. Dishonest accounting could result not just in financial penalties, but in ruined reputation, making it impossible to find future partners. In a merchant community where everyone knows everyone else, where reputation is essential for business, the incentive for honest accounting is powerful. Another form of partnership common in Islamic commerce is the musharaka, where multiple partners contribute capital and typically share in management. Imagine Ahmad entering a musharaka with 2 other merchants to purchase a ship for trading in the Indian Ocean. Each contributes 1/3 of the purchase price. Each will have a say in how the ship is used, what cargoes it carries, what routes it travels. Profits from the ship's operations will be divided equally, but so will losses if the ship is wrecked or captured by pirates. The musharaka requires even more careful accounting than the mudaraba, because all partners have management rights and therefore access to the business's resources. If one partner uses the ship for a private venture, charging the costs to the partnership while keeping the profits for himself, the others will rightfully object. The partnership's accounts must clearly distinguish between partnership business and individual business. Regular accounting reports must be prepared showing income and expenses, profits and losses. Partners must meet to review these accounts and to make decisions about the business. Islamic commercial law developed detailed rules about how partnerships should handle various situations. What if one partner contributes the ship while others contribute operating capital? What if partners contribute unequal amounts of capital? How should profits be divided? What if one partner works full-time in the business while another is passive? All these variations were discussed by legal scholars and addressed in contracts, and all required accounting to track contributions, to calculate profits, to ensure fair treatment. The sak, which gives us the English word check, was an important financial instrument in the Islamic world. A merchant in Baghdad who needed to make payment to someone in Cairo could write a sak, an order directing a banking agent in Cairo to pay a specified amount to the named recipient. The recipient would present the sak to the agent, who would verify its authenticity and make payment, then send the sak back to Baghdad for the original merchant's account to be debited. This system required coordinated accounting across distances. The banking network had to maintain records of who had funds on deposit and who was authorized to draw on those funds. When a sak was presented for payment, the agent had to verify that sufficient funds existed. When the sak was returned, it served as documentation that payment had been made. The system allowed merchants to transfer funds without physically transporting gold or silver, reducing the risk of robbery and making long-distance trade more feasible. The hawala system worked similarly, though it was less formal than the sak. A merchant in one city would give money to a hawaladar, a transfer agent, who would send a message to a corresponding agent in another city instructing payment to a specified recipient. No actual money moved between cities initially. Instead, the agents maintained accounts with each other, periodically settling balances. The system depended entirely on trust and reputation, backed by careful record-keeping of all transfers. These systems of payment and transfer were essential for the vast trading networks of the Islamic world. Merchants in Cordoba in Spain traded with merchants in Samarkand in Central Asia, a distance of thousands of miles. Trade goods moved along these routes, but moving payment required financial instruments and accounting systems that could operate across such distances. The sak and hawala provided the infrastructure, and accounting provided the memory and verification that made it trustworthy. Maritime trade presented particular accounting challenges. A merchant might invest in a shipment of goods travelling from Basra to India. The voyage would take months. During that time, the merchant's capital was tied up, inaccessible, at risk. The ship might sink in a storm. Pirates might capture it. Even if the ship arrived safely, the goods might sell poorly, or the return cargo might be damaged. All these risks had to be understood and somehow accounted for. Islamic law developed the concept of qirad, similar to the mudaraba but specifically for maritime trade. An investor would provide capital for a trading voyage. A merchant would travel with the goods, selling them abroad and purchasing goods to bring back. Upon return, profit would be calculated and divided. The accounting challenge was determining when the venture ended and profit could be calculated. If goods were sold in India and the merchant purchased spices to bring back, but the return voyage was delayed or the spices sold poorly back home, how should that be accounted for? Different legal schools had different opinions, but all agreed that clear accounting was essential. The regulation of markets by the muhtasib involved accounting as well. The muhtasib inspected weights and measures, ensuring they conformed to standards. A merchant selling grain had to use approved measures, not shortchanging customers. A money changer had to use calibrated scales for weighing gold and silver. The muhtasib would periodically check these instruments, marking approved ones, confiscating fraudulent ones. But the muhtasib also investigated fraud in accounting and pricing. If a merchant claimed to sell goods at cost plus a modest markup, a practice encouraged in Islamic ethics, the muhtasib might demand to see purchase records to verify the claimed cost. If a merchant was suspected of hoarding goods to drive up prices, the muhtasib might inspect warehouse records to see what inventory was being held. The market inspector needed to understand accounting to detect fraud. The calculation of zakat required personal accounting by every Muslim of sufficient wealth. Let's imagine a craftsman, a coppersmith named Yusuf, who needs to determine his zakat obligation. He owns his workshop and tools, which aren't subject to zakat as they're tools of his trade. He owns his house, which isn't subject to zakat as it's his residence. But he has inventory of copper vessels he's made but not yet sold. He has gold and silver coins saved. He has receivables, money owed to him by customers who bought on credit. All these are potentially subject to zakat. Yusuf must calculate the total value of his zakatable assets. The copper vessels must be valued at current market price, not at the cost of materials and labour he invested. The gold and silver are straightforward. The receivables are counted at face value if he expects to collect them, excluded if they're unlikely to be paid. He then subtracts any debts he owes. If someone lent him money that he must repay, that reduces his zakatable wealth. The remaining amount, if it exceeds the nisab, the minimum threshold, and if he's held it for a full lunar year, is subject to zakat at 2.5%. The calculation seems simple in principle, but can be complex in practice. What if Yusuf has copper ingots that he hasn't yet worked into vessels? Are these inventories subject to zakat, or raw materials that are like tools of trade? Different scholars might give different answers. What if he's in a mushraka partnership that owns goods but hasn't yet sold them and distributed profit? Is his share of the partnership's assets subject to zakat? These questions required not just accounting skill but legal knowledge, understanding of how zakat principles applied to complex commercial situations. Wealthy merchants often employed accountants specifically to handle zakat calculations and other financial matters. These weren't servants exactly, though they might be employees. They were skilled professionals, often literate when literacy was still relatively rare, able to perform complex calculations, familiar with commercial law and custom. The accountant might also serve as witness to transactions, as scribe for contracts, as agent for business dealings. The inheritance system required even more complex calculations. When a Muslim died, the estate had to be settled according to Quranic rules. First, funeral expenses had to be paid from the estate. Then any debts the deceased owed had to be settled. Then any specific bequests mentioned in a valid will, up to 1/3 of the remaining estate. Only then was the residue divided among heirs according to the fractional shares specified in Islamic law. The shares depended on which relative survived. A daughter receives half the share of a son. A wife receives 1/8 if there are children. 1/4 if not. Parents receive shares that vary depending on whether there are children. Siblings might inherit if there are no closer relatives. The permutations are complex, and working out the exact fractions required mathematical skill. Consider an example. A man dies leaving a wife, 2 daughters, and his own mother. No sons, no other children, no father, no siblings. The estate, after debts and bequests, is worth 12,000 dinars. How should it be divided? The wife receives 1/8 because there are children. That's 1,500 dinars. The mother receives 1/6 because there are children. That's 2,000 dinars. The 2 daughters divide the residue equally. The residue is 8,500 dinars, so each daughter receives 4,250 dinars. But what if the numbers don't work out evenly? What if the estate is worth an odd amount and the fractions create remainders? Islamic mathematicians developed systematic methods for solving these inheritance problems, methods that Al-Khwarizmi included in his algebra treatise. The accountant or legal scholar settling the estate needed both mathematical competence and legal knowledge to ensure the division complied with Islamic law. The documentation of all these transactions, partnerships, sales, loans that were structured to avoid interest, inheritance settlements, zakat calculations, created vast archives. Merchant houses maintained their own records, courts maintained sigils, registers of cases heard and contracts witnessed. The government maintained tax records and administrative accounts. All this paperwork accumulated over years and decades and centuries. Much of it has been lost, destroyed by fire or flood, decay or deliberate disposal, war, or simple neglect. But some survived. The Cairo Geniza, a storeroom in a synagogue in Fustat, Old Cairo, preserved hundreds of thousands of documents from the medieval Islamic world. Though these are primarily Jewish merchants' documents, Jews discarded documents containing God's name in a Geniza. Rather than destroying them, they reflect the commercial practices of the broader Islamic world, since Jews and Muslims traded together and used similar methods. The Geniza documents include partnership contracts, letters of credit, bills of lading, account books, business letters discussing prices and markets. Reading these documents, we see Islamic accounting in practice, not as legal theory or mathematical abstraction, but as working reality. A merchant writes to his partner, "I have purchased 30 bolts of silk at 8 dinars each, total 240 dinars. I paid 100 dinars from partnership funds on hand and borrowed 140 dinars at profit-sharing terms to be repaid from sales proceeds." The specificity, the precise amounts, the careful tracking of where money came from and where it went, this is accounting as lived practice. The documents also reveal the personal dimension. Merchants worried about their accounts, anxious that they might have made errors, concerned that partners might question their honesty. They wrote reassuring letters explaining unusual expenses, providing detailed breakdowns of how profit was calculated, sometimes apologizing for delays in providing accounting. The relationships between merchants, between investors and working partners, between creditors and debtors, were human relationships, coloured by emotion and trust and sometimes suspicion, all mediated through the impersonal precision of accounting records. Women participated in Islamic commerce and therefore in its accounting systems. They could own property, conduct business, enter partnerships. A wealthy widow might invest capital in mudaraba partnerships, receiving accounting reports from the working partners, reviewing their books, claiming her share of profits. A woman might own rental properties and maintain accounts of rents received and maintenance expenses. Islamic law protected women's property rights, and accounting helped enforce those rights by documenting transactions and ownership. The slave trade, unfortunately, was also part of the Islamic economy, and it too required accounting. Slaves were assets, bought and sold, sometimes used as collateral for loans. The accounting is disturbing to modern sensibilities, this treatment of human beings as property to be inventoried and valued. But the records exist, showing the prices paid, the characteristics that affected value, the transactions that move people as if they were goods. This is a reminder that accounting is morally neutral as a technique. It can be used to organise any kind of economic activity, just or unjust, and the numbers themselves don't protest. As evening approaches in the souk, merchants begin closing their stalls and shops. Account books are put away, locked in strong boxes or cabinets. The day's receipts are counted, compared against the day's sales records, discrepancies investigated and resolved. Tomorrow the work will continue, transactions will occur, records will be made, the slow accumulation of documentation that makes commerce possible and trustworthy. Think about what these accounting systems achieved. They allowed strangers to trust each other enough to form partnerships. They allowed investors to entrust their wealth to working partners they might never meet. They allowed trade to extend across continents and oceans, with goods changing hands multiple times, payments made through agents, profits calculated and distributed fairly. They allowed religious obligations like zakat and inheritance to be fulfilled according to complex rules. They allowed markets to function with some degree of honesty and standardization. The systems weren't perfect. Fraud occurred. Disputes arose. Some merchants were dishonest, but the existence of accounting standards, of legal requirements for documentation, of professional accountants and market inspectors, created a framework where commerce could flourish, where the economy could grow more complex, where wealth could be created and exchanged with reasonable confidence that obligations would be honoured and rights respected. The merchant houses of the Islamic world weren't just pursuing private profit. They were building the infrastructure of civilization, creating the networks that connected disparate regions into a single economic zone, developing the practices and methods that would eventually spread beyond the Islamic world to reshape commerce globally. And accounting was essential to all of it. The quiet foundation supporting the visible edifice of trade, the memory that allowed trust, the precision that enabled calculation, the documentation that enforced obligation. Let that understanding settle, the recognition that these mundane records, these careful calculations, these ledgers and daybooks were not mere technicalities, but the very substance of how human beings organize cooperation and exchange at a scale unprecedented in human history. The merchant in his counting house carefully recording the day's transactions, and the mathematician in his study, working through abstract problems about unknown quantities, might have seemed to inhabit different worlds. But in the Islamic Golden Age, these worlds were intimately connected. Mathematics wasn't a purely theoretical pursuit detached from practical concerns. And accounting wasn't mere mechanical bookkeeping without intellectual depth. The same scholars who advanced mathematical knowledge also applied their methods to commercial and administrative problems. The same numerical techniques that enabled sophisticated accounting also pushed forward the frontiers of mathematical understanding. Let's return to Al-Khwarizmi, whose work we touched on earlier. His treatise on algebra, written around 820, wasn't addressing an audience of pure mathematicians. It was addressing anyone who needed to solve quantitative problems. Merchants calculating profits, estate administrators dividing inheritances, tax collectors determining obligations, surveyors measuring land. The title itself indicates this practical orientation, the compendious book on calculation by completion and balancing. This is about calculation, about getting numerical answers to real problems. Al-Khwarizmi organized problems into 6 types, based on the form of the equation involved. A problem might involve only squares of the unknown quantity. Another might involve squares and simple multiples of the unknown. A third might involve simple multiples and constants without squares. For each type, Al-Khwarizmi provided systematic solution methods. These weren't just algebraic formulas in the modern sense. Medieval Islamic mathematics didn't yet have symbolic notation, where letters represent variables. Instead, Al-Khwarizmi described procedures verbally, explaining step by step what operations to perform. Consider one of his example problems. A man dies leaving sons, daughters, and other heirs. The estate must be divided according to Islamic inheritance law, with sons receiving twice what daughters receive. The estate is worth a certain amount. How much does each heir receive? Al-Khwarizmi showed how to represent the unknown, the daughter's share, as the thing, and the son's share as _quote_7_, then set up an equation. If there are 3 sons and 2 daughters, the total is 3 times twice the thing plus 2 times the thing, which equals 8 times the thing. If the estate is worth, say, 800 dinars, then 8 times the thing equals 800, so the thing equals 100. Each daughter receives 100 dinars, each son receives 200 dinars. This seems almost obvious to us because we learned algebra in school, but Al-Khwarizmi was systematizing and teaching methods that hadn't previously been organized this way in Arabic. He was making abstract reasoning about quantities accessible to people who needed to solve practical problems. A merchant who had learned Al-Khwarizmi's methods could solve problems about partnership profit division, about currency conversion at varying rates, about the time required to complete a task given certain working rates. Another mathematician who contributed to accounting practice was Abu Kamil, who lived in the late 9th and early 10th centuries in Egypt. Abu Kamil wrote a commentary on Al-Khwarizmi's algebra, extending and refining the methods. He also wrote a book of rare things in the art of calculation, which included problems about commercial transactions. One section dealt with mixing different qualities of goods. If you have wheat of one quality, worth 3 dinars per measure, and wheat of another quality worth 5 dinars per measure. How should you mix them to get wheat worth 4 dinars per measure? This mixing problem, simple as it sounds, has accounting implications. Merchants often dealt with goods of varying quality. A textile merchant might have silk of different grades, which he might combine to create a blended product. How should the combined product be priced? How should inventory be valued when it contains mixed qualities? Abu Kamil's mathematical methods helped answer these questions systematically rather than through guesswork. He also worked on problems involving geometric and arithmetic progressions, sequences of numbers where each term relates to the previous term by a constant ratio or difference. These arise in accounting when dealing with compound growth. If you invest a sum in a trading venture that generates 20% profit, and you reinvest the proceeds in another venture that also generates 20%, and you continue doing this, what total profit have you made after 10 ventures? This is a geometric progression. Each term is 1.2 times the previous term. Abu Kamil developed methods for calculating the sum of such progressions, methods that accountants could use to project long-term investment returns. Al-Khwarizmi, who lived in the late 10th and early 11th centuries, wrote works on algebra and arithmetic that explicitly addressed administrative accounting. His book Sufficient in the Science of Arithmetic discussed methods for government accountants, for calculating land taxes based on complex formulas, for converting between different units of measurement, for checking calculations to detect errors. Al-Khwarizmi understood that government administration required mathematical competence, that tax collectors and treasury officials needed systematic methods for their calculations. He also developed what we might call error-checking procedures. One method involved casting out nines. To check a multiplication, you could add the digits of each number repeatedly if necessary until you got a single digit, then multiply those single digits and compare the result to what you got from adding the digits of your original answer. If they didn't match, you'd made an error. This might sound complicated described verbally, but it's a quick mental check that accountants could use to verify calculations without repeating the entire multiplication. The development of decimal fractions was another mathematical advance with accounting implications. Earlier systems represented fractions as ratios of whole numbers, 3/5, 7/8, and so on. This worked well for some purposes, but made calculation cumbersome. Islamic mathematicians began developing methods for representing fractions decimally, extending the place value system that worked so well for whole numbers. Al-Khwarizmi, who worked in Damascus in the mid-10th century, wrote a book on arithmetic that included early decimal fraction notation. He showed how to represent amounts smaller than 1 using the same positional system used for amounts larger than 1. A scribe could write a number like 3.14, meaning 3 whole units and 14 hundredths, using the same numerals and positional logic that worked for 31 or 314. This made certain calculations much easier. Adding amounts with fractional parts became straightforward. Just line up the decimal points and add column by column. Multiplying was more complex but still systematic. For accountants dealing with prices that weren't round numbers, with quantities that needed to be measured precisely, with currency conversions where exchange rates involved fractional amounts, decimal representation was powerful. The calculation of profit in mudaraba partnerships often required dealing with fractions. If the profit-sharing ratio was 2/3 to the investor and 1/3 to the working partner, and the profit was, say, 735 dinars, the division wasn't straightforward. 2/3 of 735 is 490. 1/3 is 245. These work out evenly, but what if the profit had been 736 dinars? 2/3 would be 490 and 2/3. How should that fractional dinar be handled? Paid in smaller coins, carried forward to the next accounting period? Different merchants might handle it differently, but having mathematical methods to calculate the precise fractional amounts was essential. Islamic mathematicians also worked on what they called the problems of algebra applied to inheritance. These were precisely the estate division problems required by Islamic law. Some cases were straightforward, but others were complex. What if someone dies leaving a wife, 3 daughters, a mother and a grandfather? Each has specified fractional shares, but when you add up all the fractional shares, they exceed the whole estate. This is called an unfair problem in Islamic inheritance law, and there are specified methods for adjusting the shares proportionally. Mathematicians wrote treatises explaining these methods, providing worked examples, showing how to handle all possible configurations of heirs. The mathematician Abul-Wafa al-Buzjani, who worked in Baghdad in the late 10th century, wrote a practical geometry book for artisans and craftsmen. He included sections on calculating areas and volumes, essential for surveying land for tax assessment, for determining how much material was needed for construction projects, for measuring grain storage capacity in silos. These geometric calculations fed into accounting. You couldn't accurately tax land without knowing its area. Couldn't price construction work without knowing quantities of materials. Couldn't manage grain distribution without knowing storage volumes. Abul-Wafa also wrote on how to use measuring instruments, how to lay out right angles for construction, how to perform practical calculations in the field rather than at a desk. This bridged the gap between theoretical mathematics and practical application. An accountant in the tax administration might need to verify a surveyor's measurements, to recalculate areas based on field dimensions, to determine whether claimed acreage matched actual cultivated land. Abul-Wafa's methods made this possible for people who weren't professional mathematicians. The development of numerical tables was another contribution to practical calculation. Multiplication tables, showing the products of all single-digit numbers, were compiled and memorized. More advanced tables showed squares of numbers, cubes, square roots. Tax tables showed the tax owed on different amounts of land or production. Exchange rate tables showed currency conversions. An accountant equipped with good tables could perform calculations quickly, looking up values rather than computing them from scratch. Al-Samawal, who lived in the 12th century, worked on what might be called accounting for waqf endowments, which we'll discuss in detail later. Waqfs presented unique accounting challenges because they were perpetual. The endowment was supposed to generate income forever, supporting a mosque or school or hospital. The mathematics of this required understanding how to preserve capital while distributing income, how to account for depreciation of properties, how to ensure the endowment remained viable across generations. Al-Samawal developed methods for these calculations, showing how to determine what level of spending was sustainable, how to balance current needs against long-term preservation. The mathematical techniques we're discussing might sound abstract, but think about how they translated into daily practice. A merchant receives a shipment of goods from a partner in another city. The partner's letter states, "I have sold your goods for 823 dinars. I have taken my share of 1/3, which is 274 1/3 dinars. I am sending you your 2/3 share, which is 548 2/3 dinars, by hawala through the agent you specified." The merchant receiving this letter needs to verify the calculation. Is 1/3 of 823 indeed 274 1/3? Is 2/3 indeed 548 2/3? Do these add back up to 823? A tax collector in a rural district assesses the land tax. Each plot of land has been measured and recorded. The tax rate depends on the type of crop and the irrigation method. Rain-fed wheat is taxed at 1/10 of production. Irrigated wheat is taxed at 1/20. Dates are taxed differently than grain. The tax collector must calculate the total tax owed by the village, must track which farmers have paid and which still owe, must account for the collected revenue to his superiors. All this requires systematic calculation, careful record-keeping, and some mathematical competence. An estate administrator settles a complex inheritance. The deceased left substantial assets, houses, shops, agricultural land, goods in a warehouse, outstanding loans owed by various people. The heirs include a widow, 2 sons from a first marriage, 3 daughters from a second marriage, the deceased's mother, and a half-brother. Each has different fractional claims on the estate. The administrator must value all assets, collect outstanding debts, pay the deceased's obligations, set aside the widow's dower if it hasn't been paid, execute any valid bequests up to 1/3 of the estate, then divide the remainder according to the precise fraction specified by law. The calculation might take weeks, might require consultation with legal scholars about how to handle unusual assets, might need mathematical expertise to work out the fractional divisions. The interplay between mathematics and accounting worked both ways. Practical accounting problems drove mathematical development. Mathematicians working on inheritance division, or currency conversion, or profit calculation sometimes developed general methods that had applications beyond the specific problem. And mathematical advances, better computational methods, clearer understanding of fractions, systematic approaches to solving equations, improved accounting practice. This wasn't unique to the Islamic world, of course. Mathematics and accounting have always been related. But in the Islamic Golden Age, the connection was particularly strong and particularly fruitful. The same cultural context that valued mathematical learning also required sophisticated accounting for religious and commercial reasons. The same scholars who translated Greek geometry might also work on practical arithmetic for merchants. The same institutional support from caliphs and wealthy patrons flowed to both theoretical mathematics and practical administration. Consider the simple act of addition in the new Hindu Arabic. Numeral system. You write the numbers vertically, aligning the ones place, tens place, hundreds place. You add column by column, starting from the right. If a column sums to more than 9, you write the ones digit and carry the tens digit to the next column. This algorithm, and that's what it is, a systematic procedure, seems natural to us, but someone had to work it out, had to teach it, had to explain why it works and how to do it reliably. Al-Khwarizmi's book on calculation with Hindu numerals did exactly this for addition, subtraction, multiplication, and division. He presented each operation algorithmically as a step-by-step procedure. Follow these steps in this order and you'll get the right answer. This was teaching mathematics as technique, as craft, making it accessible to anyone who needed to calculate, not just to scholars or philosophers. The multiplication algorithm was particularly important. In the Roman system, multiplication was difficult. You essentially had to use an abacus or counting board or memorize extensive tables. But in the Hindu Arabic system, multiplication became mechanical. Multiply each digit of one number by each digit of the other number, keeping track of place value, add up all the partial products, and there's your answer. An accountant who learned this method could multiply large numbers reliably, without special equipment. Division was more complex but still systematic. Al-Khwarizmi showed how to perform long division using the Hindu Arabic numerals, building up the quotient digit by digit, subtracting multiples of the divisor from the dividend. Working through the problem in a way that could be written out and checked. For accountants who needed to divide profits among partners, or to calculate average prices, or to determine per unit costs, reliable division was essential. The rule of 3 became a standard commercial calculation method. The rule says, if quantity A corresponds to quantity B, and you have quantity C, what quantity D corresponds to C? In modern notation, this is solving A over B equals C over D for D. But medieval accountants thought of it as a proportion problem. A is to B as C is to what? For example, if 3 measures of wheat cost 5 dinars, how much will 7 measures cost? Set it up. 3 is to 5 as 7 is to what? The method is to multiply the second and third terms, 5 times 7 equals 35, and divide by the first term, 35 divided by 3 equals 11 2/3. so 7 measures cost 11 2/3 dinars. This same method works for countless commercial problems: currency conversion, pricing by weight or volume, calculating wages for different amounts of work. The rule of 3 was so fundamental that it appeared in virtually every commercial arithmetic manual. Merchants learned it, accountants used it constantly, tax collectors applied it to various assessments. It's a simple idea, maintaining proportions, but formalizing it as a systematic procedure, teaching it as a standard method, made practical calculation much more reliable. Islamic mathematicians also worked on more advanced topics that had accounting applications. The calculation of compound interest, though they wouldn't have called it interest given the prohibition of riba, came up in various contexts. If you invest in a series of trading ventures, reinvesting profits each time, how does your wealth grow? If an endowment earns income which is reinvested, how does the endowment's value change over time? These questions involved understanding exponential growth, understanding how repeated multiplication compounds. Some mathematicians explored negative numbers, though this was conceptually difficult. How can you have less than nothing? In accounting contexts, negative numbers could represent debt or loss. If you owe someone money, you could think of that as having negative wealth with respect to that person. If a partnership loses money rather than making profit, the loss is in some sense a negative profit. But working systematically with negative numbers, allowing them to participate in calculations, wouldn't fully develop until later centuries. The precision that mathematics demanded also influenced accounting practice. A mathematician expected exact answers, not approximations. If you solve an inheritance problem and the shares don't add up exactly to the estate, something's wrong. This expectation of precision transferred to accounting. An account should balance exactly. The sum of all debits should equal the sum of all credits. Revenue minus expenses should equal profit precisely, not approximately. The mathematical mindset demanding logical consistency, expecting precise numerical relationships, shaped how accounting was practiced. Let's think for a moment about what it must have been like to learn these methods in the medieval Islamic world. A young man, perhaps the son of a merchant, is apprenticed to learn commercial arithmetic. He begins by memorizing the Hindu Arabic numerals, learning to write them clearly, understanding how position determines value. He practices addition and subtraction until the procedures become automatic. He moves on to multiplication, first memorizing the multiplication table, then learning the algorithm for multiplying large numbers. Division comes next, more difficult, requiring careful attention to each step. Then come practical problems, currency conversion. If 1 gold dinar equals 12 silver dirhams, how many dirhams equal 27 dinars? Partnership division. If 3 partners invest in ratios of 3 to 5 to 7, and the profit is 450 dinars, how much does each receive? Discount calculation. If a merchant offers a discount of 1/10, what is the final price for goods worth 80 dinars? Each problem type has its method, its procedure, its way of setting up and solving. The learning is practical and procedural, focused on getting right answers to real problems. But it's also mathematical, requiring understanding of why the methods work, not just mechanical application. A good teacher would explain the logic behind the algorithms, would show why carrying works in addition, why the rule of 3 maintains proportion, why the inheritance formulas produce the correct fractional divisions. Understanding enabled adaptation, allowed the student to handle problems that didn't fit standard templates, to check work for errors, to explain calculations to others. Some students would go further, studying more advanced mathematics, algebra, geometry, perhaps even astronomy, which required sophisticated calculation. But even those who stopped with commercial arithmetic had acquired valuable skills. They could work as accountants, as commercial agents, as administrators. They could keep reliable records, could verify others' calculations, could participate in the increasingly complex commercial and administrative life of the Islamic world. The spread of these mathematical and accounting methods followed trade routes and administrative networks. A method developed in Baghdad might be carried to Cairo by a merchant who'd learned it in partnership with a Baghdad trader. From Cairo, it might reach Kairouan in North Africa, carried by a student who'd studied in Cairo. From Kairouan, it might reach Cordoba in Al-Andalus, Spain, brought by a scholar or merchant. Each transmission might involve slight modification, adaptation to local custom, refinement based on practical experience. Books also spread these methods, though books were expensive and relatively rare in the pre-printing era. A mathematical treatise might be copied by a student for his own use, or by a professional copyist commissioned by a wealthy patron. Each copying introduced the possibility of error, a number misread, a step in an algorithm omitted, a diagram poorly rendered. But each copying also spread knowledge, made techniques available to new audiences, allowed accumulated wisdom to reach beyond the original author's immediate circle. As night falls, imagine a student in his room, illuminated by an oil lamp, working through problems from a mathematics text. He writes calculations on a tablet or on paper if he can afford it. Each problem solved is a small victory, evidence that he understands, that he can apply the methods. Tomorrow he'll work as an apprentice accountant in his uncle's merchant house, recording transactions, calculating profits, learning the practical art of keeping books. But tonight he's solving algebraic problems about inheritance, about partnership profits, about currency conversion. The mathematics he's learning isn't separate from the accounting he'll practice. It's the foundation, the systematic knowledge that will make him competent, that will enable him to handle complex calculations reliably, that will make him valuable in a world increasingly organized through numbers and records. Let that image rest, the quiet work of learning, of mastering calculation, of acquiring the skills that would organize commerce and administration, that would make trust possible across distances, that would allow the Islamic world to achieve unprecedented economic complexity and scale. The mathematics of commerce and administration dealt with transactions that concluded, with partnerships that ended, with profits that were calculated and distributed. But the Islamic world developed another institution that posed a unique challenge to accounting, the waqf. A charitable endowment meant to last forever. How do you account for something designed to continue perpetually, that must preserve its principle while generating income, that must serve future generations as well as the present? This question produced some of the most sophisticated accounting practices in the medieval Islamic world, creating systems that would preserve records across centuries. The word waqf means, literally, to stop or to hold. In legal terms, it refers to property permanently dedicated to charitable purposes. The donor removes the property from ordinary commerce, dedicating it to God's service in perpetuity. The property itself, usually land or buildings, can never be sold or inherited or transferred. But the income it generates must be used for specified charitable purposes, supporting a mosque, funding a school, maintaining a hospital, providing for the poor, supplying water to travellers, any worthy purpose the donor designates. The institution emerged early in Islamic history. The Prophet Muhammad himself established waqfs, dedicating certain properties to charitable use. His companions did likewise. By the 8th and 9th centuries, waqfs had become a major feature of Islamic society, supporting most religious and educational institutions, providing many social services, and representing a substantial portion of total wealth in Islamic lands. Let's imagine a wealthy merchant in 9th century Baghdad, a man named Hassan who has prospered in the silk trade and wishes to create a lasting legacy. He owns several shops in the commercial district and some agricultural land outside the city. As he ages, Hassan contemplates mortality and wishes to ensure his wealth continues to do good after his death. He decides to establish a waqf. Hassan consults a legal scholar about how to structure the endowment properly, The scholar explains the requirements. Hassan must clearly specify the property being dedicated, the charitable purpose it will serve, and who will administer it. The waqf deed must be witnessed and registered with the qadi, the Islamic judge. Once established, the waqf is irrevocable. Hassan cannot change his mind later, cannot reclaim the property, cannot alter the fundamental terms. Hassan decides to dedicate 3 shops in the goldsmith's esuk and 10 feddans of agricultural land. The shops generate rental income. The goldsmiths pay rent monthly to operate their businesses in Hassan's shops. The agricultural land produces crops, part of which the farmer keeps as his share, and part of which belongs to Hassan as the landowner. All this income, Hassan declares, will support a mosque he has built in his neighbourhood. The income will pay for the mosque's upkeep, for the imam who leads prayers, for oil to light the lamps, for repairs to the building, for copying Qurans for the use of worshippers. The waqf deed is prepared carefully, describing the properties precisely, the location of each shop, the boundaries of the agricultural land. It specifies that Hassan himself will serve as nazir, administrator, during his lifetime, and after his death the position will go to his eldest son and then to subsequent generations of his descendants. If his line ends, the qadi will appoint a trustworthy person to serve as nazir. The deed specifies how the income should be spent, first for maintenance of the mosque building, then for the imam's salary, then for other mosque expenses, and any surplus should be saved for future needs or extraordinary repairs. The deed is signed by Hassan, witnessed by 2 reliable Muslim men, and presented to the qadi who reviews it to ensure it complies with Islamic law. The qadi adds his certification and registers the waqf in the court records, the sigil. From this moment, the waqf exists as a perpetual entity. The properties Hassan dedicated no longer belong to him or his heirs. They belong to God, held in trust for the specified charitable purpose. Now Hassan faces an accounting obligation that will extend far beyond his lifetime. As Nazir, he must keep careful records of the waqf's income and expenses. He must track rental income from the 3 shops, how much each goldsmith pays monthly, whether payments are on time, whether any arrears exist. He must track agricultural income from the land, how much grain or other crops are produced each season, what share belongs to the waqf, what price is received when crops are sold. On the expense side, Hassan must record everything spent on the mosque, payments to construction workers for repairs, purchases of oil for lamps, the imam's monthly stipend, the cost of mats for worshippers to pray on, expenses for cleaning and maintenance. Every dirham spent must be documented, must be justifiable as serving the waqf's purpose. This accounting serves multiple purposes. It allows Hassan to ensure the waqf is functioning properly, that income is sufficient to cover expenses, that the mosque is being maintained adequately. It allows oversight. The qadi or other authorities could review the accounts to verify proper administration. It allows continuity. When Hassan dies and his son takes over as Nazir, the records will show the waqf's financial history, will establish patterns of income and expense, will guide proper administration. But most importantly, the accounting is a form of accountability before God. Hassan has dedicated this property to divine service. He holds it in trust, not for his own benefit, but for the purposes he specified. Honest, careful accounting is a religious obligation. Evidence that the trust is being faithfully executed. The long-term nature of waqfs created unique challenges. Properties depreciate, buildings need repairs, circumstances change. A shop that generates good rental income in one century might become less valuable if the commercial district shifts. Agricultural land might become more or less productive as irrigation systems improve or deteriorate. How should the Nazir account for these long-term changes? Islamic legal scholars develop the principle that waqf property must be preserved. The Nazir cannot allow buildings to fall into ruin, cannot let agricultural land become barren through neglect. If repairs are needed beyond what current income can fund, The Nazir should save surplus income in good years to cover extraordinary expenses in bad years. If a waqf building becomes so dilapidated that repair is impossible or uneconomical, the Nazir can, with court approval, sell the ruined property and purchase replacement property that can serve the waqf's purpose. This preservation obligation required accounting across time horizons that exceeded human lifespans. A Nazir making decisions today about maintenance and expenditure must consider effects decades hence. If you defer needed repairs to save money now, the building might deteriorate to the point where much more expensive repairs are needed later. If you spend all current income without building reserves, you'll have nothing for emergencies or major repairs. This long-term thinking is unusual in commercial accounting, where ventures typically conclude and profits are distributed. Waqf accounting is perpetual accounting, designed for an entity that never ends. Let's consider a specific accounting challenge. Hassan's waqf owns 3 shops. Each shop is a separate physical structure, requiring separate maintenance. In a given year, one shop needs major repairs. Perhaps the roof is leaking, threatening water damage to the goldsmith's inventory. The repair will cost 200 dinars. The shop generates 70 dinars in annual rent. The other 2 shops generate 60 dinars each. Total annual waqf income from the shops is 190 dinars. Agricultural income adds another 100 dinars for total income of 290 dinars. Annual expenses for the mosque are usually about 250 dinars, 120 for the imam's salary, 50 for oil and supplies, 30 for routine building maintenance, 50 for miscellaneous expenses. This normally leaves a surplus of 40 dinars annually, but the shop repair costs 200 dinars. Current surplus is insufficient. Hassan, as Nazir, has several options. He could defer the repair, but that risks worse damage and higher cost later. He could reduce mosque expenses, but the imam's salary is already modest and can't easily be cut. He could use accumulated surplus from previous years if he's been saving, which is the prudent approach. The accounting records show that Hassan has indeed been saving surpluses. Over the previous 5 years, the waqf has accumulated 210 dinars in reserves. This is precisely the situation the reserves were meant for. Hassan authorises the repair, drawing 160 dinars from reserves, the repair cost minus the current year's expected surplus. The reserves drop to 50 dinars, but the shop is repaired, the income stream is protected, and the waqf's long-term viability is preserved. All of this must be documented. The accounting record shows the special expense, explains why it was necessary, shows how it was funded, tracks the remaining reserve balance. Future Nazirs reviewing these records will understand that major repairs occur periodically and that maintaining adequate reserves is essential. Waqf accounting records were often kept in bound registers, carefully maintained, stored in secure locations. Some waqfs employed professional accountants to maintain the books, especially large waqfs with extensive properties and complex finances. These accountants would prepare regular reports, perhaps monthly or quarterly, summarizing income and expenses, calculating balances, noting any unusual items requiring the Nazir's attention. The level of detail in waqf accounting could be remarkable. Consider the waqf of Zubaydah, the wife of Caliph Harun al-Rashid. She established waqfs to support infrastructure for pilgrims travelling to Mecca, wells, cisterns, rest stations along the pilgrimage route. The waqf properties that funded this work included agricultural estates in Iraq and commercial properties in Baghdad. The accounting had to track income from scattered sources, expenses for maintaining facilities along a route stretching hundreds of miles, and capital reserves to ensure perpetual operation. The Nazirs of Zubaydah's waqf maintained detailed records of which wells needed repair in which years, what the repairs cost, which cisterns were refilled, what supplies were purchased for rest stations. They tracked the agricultural production from the estates, how many bushels of wheat, dates, barley each estate produced each year, what prices were received, what taxes were paid to the government before the waqf received its share. They tracked rental income from urban properties, noting when tenants changed, when rent was renegotiated, when major repairs were needed. These records served practical purposes, but they also served as testament. The waqf was Zubaydah's act of piety, a contribution to the welfare of pilgrims. The careful accounting demonstrated that her charitable intention was being faithfully executed, that the trust she established was functioning as intended, that her legacy continued generation after generation. The accumulation of waqf records over centuries created vast archives. The court registers, the sigils, contain the original waqf deeds, plus periodic reports from nazirs, plus court cases involving waqf disputes. Major mosques and schools supported by waqfs maintained their own records. Some of these archives survived and provide extraordinary windows into medieval Islamic economic and social life. From Ottoman-era waqf records, for instance, historians have reconstructed detailed pictures of urban life in 16th and 17th century Istanbul, Damascus, and Cairo. We know what properties existed, how much they rented for, how rental values changed over time, what kinds of charitable services were funded. But the practice of waqf accounting extends much earlier to the first centuries of Islam, and the principles were established in the medieval period we're exploring. One accounting challenge waqfs faced was inflation. Over decades and centuries, the value of money changed. A salary that seemed generous when the waqf was established might become inadequate generations later. Rents that were fixed by agreement might fail to keep pace with rising costs. How should nazirs handle this? Islamic law allowed some flexibility. Fixed rents could be renegotiated periodically if both parties agreed. Salaries specified in the waqf deed could be adjusted if necessary to fulfill the waqf's purpose. If the intention was to support a capable imam, and the specified salary was no longer sufficient to attract someone qualified, the nazir could increase it using the waqf's income, as long as this didn't violate the founder's fundamental intentions. But this flexibility created accounting complexity. How do you maintain consistency across generations, while also adapting to changing circumstances? The solution was detailed record-keeping, explaining the reasoning behind any significant change. If a nazir increased the imam's salary beyond what the waqf deed specified, the accounting record would explain why. The cost of living had increased, the previous salary was insufficient, comparable positions at other mosques paid more, and qualified candidates were unwilling to accept the position at the old rate. This documentation justified the decision and guided future nazirs. Some waqfs were established specifically for educational purposes, supporting madrasas, Islamic colleges where students studied religion, law, literature, and other subjects. These educational waqfs faced unique accounting challenges. They had to track income from endowed properties, expenses for building maintenance, salaries for teachers and administrators, stipends for students, costs for books and supplies. They had to account for the number of students supported. The waqf might specify supporting a certain number of students, and the nazir had to document that the specified number were indeed being supported. The Nizamiya Madrasa in Baghdad, established in the 11th century by the vizier Nizam al-Mulk, was supported by extensive waqf properties. The accounting records tracked income from agricultural estates and urban properties scattered across the empire. They tracked expenditures for the substantial building complex, for salaries of numerous professors teaching different subjects, for stipends paid to students which allowed them to study without working, for the considerable library that was assembled and maintained. The accounting also had to address questions like, if a teacher dies mid-year, should his salary continue to be paid to his heirs, or should it stop immediately, or should it continue until a replacement is found? If a student drops out, should his stipend continue or stop? If the number of qualified applicants exceeds the number of positions the waqf can fund, how should the selection be made and how should this be documented? These weren't just administrative questions, but accounting questions, requiring clear policies and careful documentation. Waqfs could also own commercial enterprises, not just rental properties. A waqf might own a bathhouse, operated for profit, with the income supporting the charitable purpose. The bathhouse needed its own accounting, income from customers, expenses for fuel to heat the water, wages for staff who maintained the facility, costs for repairs and supplies. This business accounting had to be integrated with the overall waqf accounting, showing how the bathhouse contributed to the total income available for the waqf's purpose. Some scholars have argued that waqf institutions were economically inefficient because they removed property from the market, made it impossible to sell or transfer, and could lead to poor management if nazirs were incompetent or dishonest. There's some truth to this. Perpetual trusts do create rigidity. And not all nazirs were capable or honest. But the waqf system also had advantages. It created long-term stability for charitable institutions, ensured consistent funding for social services, and removed the property from the cycle of inheritance division that could fragment estates into economically unviable pieces. The accounting systems developed for waqfs influenced other areas of Islamic administration. The idea of accounting for long-term entities, of maintaining reserves for future needs, of documenting decisions to guide successors, these concepts transferred to government administration, to family business management, to any situation requiring continuity across generations. The position of Nazir was one of trust and responsibility, requiring integrity, competence, and long-term thinking. Some Nazir positions became hereditary, passing from father to son, creating families specialized in waqf administration. These families developed expertise in accounting, in property management, in legal requirements, becoming professional administrators of charitable endowments. The oversight mechanisms for waqfs also influenced accounting practice. The Qadi could review a Nazir's accounts if there were complaints or concerns. Beneficiaries of a waqf, say, the congregation of a mosque or the students at a school, could petition the court if they believed the Nazir was mismanaging the endowment. This potential for external review encouraged careful, honest accounting. A Nazir who kept poor records or who couldn't account for expenditures might be removed from the position and might face financial penalties if mismanagement was proven. Let's return to Hassan, the merchant who established a waqf for his neighborhood mosque. He serves as Nazir for 23 years before his death. During this time, he maintains careful records, saves surpluses for future needs, ensures the mosque is well maintained and adequately funded. When he dies, his eldest son Ibrahim inherits the position of Nazir. Ibrahim receives the waqf's account books from his father's estate. He sees the history of income and expenses, the pattern of ordinary costs and occasional extraordinary repairs, the level of reserves that has been maintained. This historical data guides Ibrahim's administration. He knows roughly what to expect for annual income, what normal expenses are, what constitutes an adequate reserve. He continues his father's careful accounting, adding his own entries, preserving the records, eventually passing them to his own son. Centuries might pass. The original properties might be replaced, the 3 shops perhaps sold when that commercial district declined and replaced with properties elsewhere. The mosque might be rebuilt or expanded. The political context might change completely. Dynasties rise and fall, empires come and go. But the waqf continues, serving its original purpose. Because the accounting system provides continuity, provides memory, provides guidance across the vast gulf of time. Some waqf records survive today, offering scholars remarkable access to economic and social history. The Ottoman waqf registers, for instance, provide detailed documentation of properties, income, expenses across centuries. Earlier Islamic waqf records are rarer. Many were lost to war, fire, decay, neglect. But where they survive, they offer extraordinary detail about medieval Islamic life. Think about what this means. The accounting systems developed for waqfs were designed for eternity, for entities that would outlive their founders by centuries, for purposes that transcended individual lifetimes. This required a different mentality than commercial accounting, where ventures conclude and partnerships dissolve. This was accounting as sacred duty, as stewardship, as preservation of intention across time. The Waqf Nazir, keeping his accounts by lamplight, isn't just tracking income and expenses. He's maintaining a connection between past and future, between the founder's charitable intention and its perpetual fulfillment, between the dead who establish the trust and the living who benefit from it. The numbers he records, the calculations he performs, the documentation he preserves, all of this is an act of fidelity, of honouring obligation, of ensuring that generosity endures. As we consider this, let the pace slow a bit. Think about accounting designed to last forever. Records meant to guide people not yet born. Systems built to preserve intention across centuries of change. There's something profound in this, something that transcends the mere technique of bookkeeping. It's about human beings trying to create permanence in an impermanent world, using numbers and documentation and careful procedure to build something that will outlast them, that will continue serving good purposes long after their names are forgotten. The Waqf accountant's work was humble, often anonymous, but it was also noble, essential to making charity perpetual, to ensuring that gifts continued giving generation after generation after generation. Let that understanding rest quietly as we prepare to explore how these Islamic accounting practices spread beyond the Islamic world itself, carrying their methods and principles to Europe and beyond. The accounting systems developing in Baghdad and Cairo, in Damascus and Cordoba, weren't confined to the Islamic world. Knowledge, like trade goods, travels along routes of commerce and conquest, of pilgrimage and scholarship, of migration and curiosity. The mathematical and accounting innovations of the Islamic Golden Age would eventually transform how the entire world organized economic information. But this transmission took centuries and followed complex, winding paths across continents and cultures. Let's travel westward first, to Al-Andalus, the Islamic territories in the Iberian Peninsula. When Muslim forces crossed from North Africa into Spain in 711, they brought with them not just military power, but administrative expertise, including accounting methods. By the 9th and 10th centuries, Al-Andalus had become a sophisticated civilization in its own right, with Cordoba rivaling Baghdad as a centre of learning and culture. The Umayyad Caliphate of Cordoba, independent from the Abbasid Caliphate in Baghdad, developed its own administrative apparatus but drew heavily on Islamic accounting practices. The tax system required careful record-keeping of agricultural production, of urban commerce, of customs duties on trade. The court maintained elaborate accounts of revenue and expenditure. The waqfs that supported mosques and schools in Cordoba and other Andalusian cities kept records following the same principles we've discussed. But Al-Andalus was unique in medieval Europe as a place where Islamic, Christian and Jewish communities lived in relative proximity, sometimes in conflict but also in extensive interaction. This created opportunities for knowledge transfer across religious and cultural boundaries. Christian merchants trading with Muslim merchants learned Islamic commercial practices. Jewish scholars studying in Cordoba's libraries encountered Arabic mathematical texts. The circulation of ideas was messy and complicated, shaped by politics and prejudice, but it happened. Christian scholars in northern Spain, in kingdoms not under Muslim rule, became aware of the superior mathematical and astronomical knowledge preserved in Arabic. Some learned Arabic to access this knowledge directly. Others relied on translation. The city of Toledo, which was reconquered by Christian forces in 1085, became a major translation centre. The Arabic manuscripts in Toledo's libraries were translated into Latin, making Islamic learning accessible to Christian Europeans. Among the texts translated were mathematical works, including those on calculation using Hindu-Arabic numerals. The treatises of Al-Khwarizmi were translated into Latin in the 12th century. His book on arithmetic, explaining the new numerals and their use, became known as Algoritmi de Numero Indorum, Al-Khwarizmi on Indian numbers. From this title, Europeans would derive the word algorithm. His algebra treatise was translated as Liber Algebrae et Almukabola, giving Europeans the word algebra. But the most influential transmitter of Islamic mathematics to Europe was an Italian merchant's son named Leonardo of Pisa, better known as Fibonacci. Born around 1170, Leonardo grew up in Bugia, a trading port in North Africa where his father was a commercial representative. Leonardo learned Arabic and studied with Muslim teachers, learning Islamic mathematics including the use of Hindu-Arabic numerals. In 1202, Leonardo published his masterwork, the Liber Abaci, quote 14. The book wasn't about the abacus, despite the title. It was about calculation using the new numerals, what Leonardo called the 9 Indian figures plus 0. The book was explicitly aimed at merchants and accountants, showing how the new numerals made commercial calculations easier and more reliable than the methods Europeans had been using. Leonardo presented the numerals and explained their positional value system. He showed how to add, subtract, multiply and divide using these numerals. Then he worked through hundreds of practical problems: currency conversion, profit calculation, partnership division, compound interest, problems about mixtures and alloys, problems about wages and work rates, problems requiring algebra. Many of these problems and solution methods came directly from Islamic sources, from Al-Khwarizmi, from Abu Kamil, from other Islamic mathematicians Leonardo had studied. The Liber Abaci had enormous influence, though its impact unfolded slowly over generations. Italian merchants, especially in commercial centres like Pisa, Florence and Venice, gradually adopted the Hindu-Arabic numerals for their accounting. The advantages were too great to ignore. Multiplication and division became far easier. Calculations could be written out and checked. Errors were easier to spot and correct. But adoption wasn't immediate or universal. Roman numerals persisted in official documents and records for centuries. Some guilds and institutions resisted the new numerals, viewing them as foreign and suspicious. The word quote 16, derived from the Arabic siyafar for 0, became associated with secrecy and code because the new numerals were unfamiliar and mysterious to those who hadn't learned them. Only gradually, over the 13th, 14th and 15th centuries, did Hindu-Arabic numerals become the standard in European commerce and accounting. The Italian merchant cities developed sophisticated accounting practices, building on Islamic foundations but also innovating. By the 14th century, Italian merchants were using a system that would eventually be codified as double-entry bookkeeping. Every transaction was recorded twice, once as a debit and once as a credit. Assets equaled liabilities plus capital. The books balanced systematically, providing automatic error checking and a comprehensive view of financial position. The relationship between Islamic accounting methods and Italian double-entry bookkeeping is debated by scholars. Did double-entry develop independently in Italy, or did it emerge from Islamic practices encountered through Mediterranean trade? The evidence suggests both influence and innovation. Islamic accounting had elements that resembled double-entry. The understanding that transactions have two sides, the maintenance of multiple account books, the systematic organization of records. But the full double-entry system as practiced in Italy seems to have been a European development, building on but going beyond Islamic methods. In 1494, a Franciscan friar and mathematician named Luca Pacioli published the Summa de Arithmetica, a comprehensive mathematics encyclopedia that included a section on bookkeeping. Pacioli's treatment of double-entry bookkeeping, called the quote 17, became the standard reference. His work spread the system throughout Europe, making double-entry the foundation of modern accounting. Pacioli acknowledged his debts to earlier mathematicians, including Fibonacci, and Fibonacci had acknowledged his debts to his Arabic teachers. The chain of transmission is clear, from India to the Islamic world, from the Islamic world to Al-Andalus and North Africa, from there to Italy through merchants and scholars like Fibonacci. from Italy throughout Europe through works like Pacioli's. The accounting systems used in Renaissance Florence and modern New York have roots reaching back to the House of Wisdom in Baghdad and ultimately to ancient India. Let's trace another path of transmission, eastward and southward from the Islamic heartland. When Islam spread into South Asia, reaching Sind in the 8th century and expanding more extensively in subsequent centuries, Islamic and Indian mathematical and commercial traditions encountered each other. The Hindu-Arabic numerals, after all, originated in India before being adopted and transmitted by Islamic civilization. This created interesting feedback loops where knowledge circulated in complex patterns. The Delhi Sultanate, established in 1206, ruled much of northern India using administrative systems influenced by Persian and Arabic models. The Diwan system was adopted, with various administrative departments maintaining accounts in Persian, the language of administration in much of the Eastern Islamic world. Tax collection, military pay, court expenses, all required accounting, and the methods used drew on Islamic practices. In Southeast Asia, as Islam spread through maritime trade routes, Islamic commercial practices followed. The great port cities of the Indonesian archipelago, places like Malacca, which became Muslim in the 15th century, saw Islamic commercial law and accounting methods adopted alongside the religion itself. The Mudaraba and Musharaka partnerships were used for financing trade voyages. The prohibition of riba was observed, requiring alternative financial structures. Merchants maintained accounts following Islamic principles. The Swahili coast of East Africa provides another example of Islamic accounting influence spreading through trade. From perhaps the 9th century onward, Muslim merchants from Arabia and Persia established trading settlements along the African coast in what is now Somalia, Kenya, and Tanzania. Cities like Kilwa and Mombasa became prosperous trading centres, exporting gold and ivory from Africa's interior and importing goods from across the Indian Ocean world. These Swahili city-states operated within Islamic commercial frameworks. Merchants formed partnerships following Islamic law. They used sukuk, written orders for payment. They established waqfs to support mosques and schools. The accounting practices that enabled this commerce were Islamic in origin and principle, adapted to local conditions but recognizable as part of the broader Islamic commercial world. Back in Europe, the transmission of Islamic knowledge continued through multiple channels. The Crusades, despite being military conflicts, created opportunities for cultural contact. Crusaders returning from the Levant brought back knowledge of Eastern practices, including in some cases commercial and accounting methods they'd observed. This transmission was limited and often hostile in character. Crusaders weren't primarily interested in learning from those they fought, but some knowledge transferred nonetheless. More peaceful were the intellectual exchanges in Sicily, which had been under Muslim rule before being conquered by Normans in the 11th century. The Norman rulers, and later the Holy Roman Emperor Frederick II, patronised scholarship and encouraged translation of Arabic works into Latin. Sicily became another transmission point, where Islamic learning reached Christian Europe. Universities emerging in medieval Europe, Bologna, Paris, Oxford, began teaching mathematics, including material derived from Arabic sources. The curriculum included algorithm, the art of calculating with the new numerals. Students learned from Latin translations of Islamic mathematical texts. Not all universities adopted this immediately. Some remained focused on traditional learning based on classical Latin texts, but gradually the influence of Islamic mathematics permeated European education. European merchants and accountants began writing their own manuals on commercial arithmetic, often called abaco books in Italian, teaching calculation for practical business purposes. These manuals drew heavily on Islamic sources, sometimes copying problems directly from Arabic texts, sometimes adapting methods to European contexts. The abaco tradition created a body of practical mathematical knowledge oriented toward commerce, creating a bridge between Islamic mathematics and the mathematical practices of the Renaissance. the Jewish communities scattered across the Mediterranean world played an important intermediary role. Jews lived in both Christian and Islamic lands, often serving as merchants and translators. They were generally literate in multiple languages: Hebrew for religious purposes, Arabic in Islamic lands, Latin or local vernaculars in Christian lands. This multilingualism positioned them to transfer knowledge across cultural boundaries. The Cairo-Geniza documents we mentioned earlier include extensive correspondence among Jewish merchants trading across the Mediterranean, from Egypt to Tunisia to Spain to Sicily. These merchants operated comfortably in both Islamic and Christian commercial spheres, using accounting methods that were essentially Islamic in origin, but adapted to whatever local context they worked in. When a Jewish merchant from Egypt did business with a Christian merchant from Venice, they might reconcile different accounting practices, but the underlying mathematics, the Hindu-Arabic numerals, the calculation methods, the commercial arithmetic, was increasingly shared. The Mongol conquests of the 13th century created another mechanism for knowledge transmission. The Mongol Empire at its height stretched from China to Eastern Europe, creating unprecedented connections across Eurasia. Merchants and scholars could travel safely across this vast space. Persian accountants in Mongol service might encounter Chinese accounting methods. Ideas and practices circulated along the Silk Road. The Mongol Ilkhanate that ruled Persia and Mesopotamia in the 13th and 14th centuries employed Persian administrators who maintained sophisticated accounting systems. These combined Islamic accounting practices with innovations prompted by the challenge of administering a vast, diverse empire. Some accounting techniques developed in this context may have spread westward into Europe and eastward into China. Let's think about what this transmission of accounting knowledge actually meant in practice. It wasn't just abstract information moving from place to place. It was merchants learning that recording transactions in a particular way made their businesses more manageable. It was administrators discovering that systematic accounts made tax collection more efficient and less prone to corruption. It was judges finding that documented financial records made resolving commercial disputes easier and fairer. When a Venetian merchant in the 14th century used Hindu-Arabic numerals to calculate the profit on a shipment of spices from Alexandria, he was using a technology that had travelled from India through the Islamic world, through Islamic Spain or North Africa, through Italy to reach him. He probably didn't know or care about this history. He just knew the new numerals worked better than Roman numerals for his purposes. But his ability to calculate quickly and accurately, to maintain clear accounts, to verify his partner's calculations, all depended on this long chain of transmission. When a French tax collector in the 15th century recorded revenue in account books, organised systematically by district and type of tax, he was using organisational methods that had been refined over centuries in Islamic administration and transmitted through various channels, perhaps through contact with Iberian kingdoms that had adopted Islamic practices, perhaps through Italian merchants who had learned from Islamic traders, perhaps through Latin translations of Arabic administrative manuals. The resistance to new methods is also part of the story. Change came slowly and unevenly. Some people embraced new accounting methods because they saw practical advantages. Others resisted from conservatism, from suspicion of foreign innovations, from institutional inertia. In some European cities, certain types of official documents had to be written in Roman numerals by law even after merchants had adopted Hindu-Arabic numerals for their private accounts. The new displaced the old gradually, through accumulating small advantages that made the new methods irresistibly more efficient. By the end of the 15th century, the medieval period was giving way to what historians call the early modern period. Europe was on the eve of massive expansion, the voyages of exploration that would connect Europe with the Americas, with new routes to Asia, with global trading networks. The commercial revolution that would create modern capitalism was beginning, and the accounting systems that would track and enable this expansion were largely based on methods and knowledge that had been developed in the Islamic world and transmitted to Europe. The Hindu-Arabic numerals were now standard in European commerce. double-entry bookkeeping was spreading from Italy to other commercial centres. Mathematical education was advancing, creating populations of merchants, accountants and administrators who could calculate reliably. The infrastructure of modern accounting was in place, and much of it had Islamic roots, though this would be largely forgotten as Europeans came to think of these methods as simply modern or Western. The transmission wasn't only westward, of course. Islamic accounting continued to develop within the Islamic world itself. The Ottoman Empire, which rose to prominence in the 15th and 16th centuries, developed extraordinarily sophisticated accounting systems for its vast territories. Ottoman accounting drew on earlier Islamic practices, but also incorporated influences from Byzantine administration and European methods encountered through trade and diplomacy. Ottoman tax registers, called defter, recorded information about land, production, taxation, and population with remarkable precision. The central treasury maintained detailed accounts of revenue from provinces across the empire and expenditures for military, administrative, and court purposes. The system required thousands of trained accountants, scribes, and administrators, creating a professional bureaucracy that sustained the empire for centuries. Similarly, the Safavid Empire in Persia and the Mughal Empire in India maintained accounting systems rooted in Islamic practices, but adapted to their particular circumstances. The Mughal Emperor Akbar, ruling in the late 16th century, reformed tax administration and accounting, creating systems that would influence Indian administration even under later British colonial rule. The circulation of accounting knowledge was thus multidirectional and ongoing. Europe learned from the Islamic world. The Islamic world continued developing its own practices. New centres of innovation emerged. Methods were adapted, refined, recombined. By the 17th century, accounting had become a global phenomenon, with regional variations but also shared principles and techniques that transcended cultural and religious boundaries. Think about a merchant in 17th century Amsterdam using double-entry bookkeeping to track his trade with the East Indies, or an accountant in 17th century Istanbul recording revenue in an Ottoman defter, or a merchant in 17th century Isfahan calculating zakat on his wealth. They would use different languages, serve different political and religious systems, operate in different cultural contexts, but they would all use positional numeration with a symbol for zero. They would all maintain systematic records of transactions. They would all calculate using methods whose origins traced back through the Islamic Golden Age to ancient India and Mesopotamia. The accounting systems we've been exploring weren't just technical innovations, though they were that. They were part of humanity's gradual development of tools for managing complexity, for extending trust across distance and time, for organising cooperation among strangers, for making the invisible visible through documentation and calculation. The journey from clay tablets in Sumer to double-entry ledgers in Venice took millennia and crossed countless cultural boundaries. Islamic civilization occupied a crucial position in this journey, preserving knowledge from the ancient world, adding innovations from India, developing new mathematical and administrative methods, and transmitting all of this to medieval and Renaissance Europe. As we prepare to move toward the conclusion of our journey, let this transmission rest in your mind, the slow, complex, sometimes contested movement of knowledge across boundaries of language and religion and empire, driven by the practical needs of merchants and administrators, enabled by the curiosity of scholars, creating gradually a shared mathematical and accounting language that would unite the world's commerce even when politics and religion divided it. The numbers that organise our modern economy, the methods we use to track wealth and obligation, the very symbols we write when recording financial information, all carry within them echoes of this long history of transmission and transformation, of knowledge travelling like seeds on the wind, taking root in new soil, growing in new forms, but carrying within them the essence of their origins. The transmission of Islamic accounting knowledge to Europe that we've traced, through Al-Andalus and Sicily, through translations in Toledo, through merchants like Fibonacci, through the gradual adoption of Hindu-Arabic numerals and systematic bookkeeping, represents a crucial moment in human intellectual history. But the story doesn't end with medieval transmission. The legacy of Islamic accounting continues to shape our world in ways both obvious and subtle, through direct continuity in Islamic finance, and through the foundations it laid for modern accounting practices that the entire world now uses. Let's trace first how Islamic accounting principles directly evolved into contemporary Islamic finance. Through the centuries following the Islamic Golden Age, through the Ottoman period and into the modern era, Islamic commercial practices continued in Muslim communities worldwide. Merchants formed partnerships avoiding interest, calculated zakat on their wealth, established waqfs for charitable purposes. But by the 19th and 20th centuries, as European colonial powers dominated much of the Muslim world, Western banking and finance became the global standard. Western banks operated on interest-based lending, fundamentally incompatible with Islamic prohibition of riba. Muslims living in colonized lands or in modernizing Muslim countries faced a dilemma: participate in the modern economy through institutions that violated Islamic principles or remain economically marginalized. For much of the 19th and 20th centuries, many Muslims chose pragmatic participation, sometimes uncomfortably, sometimes with religious scholars providing justifications or exceptions. But in the mid-20th century, a movement began to revive genuinely Islamic finance, creating modern institutions that operated according to classical Islamic principles. The first experiment was the Mit Kamr Savings Bank in Egypt, established in 1963. It was a small rural bank that accepted deposits without paying interest and provided financing through profit-sharing partnerships rather than interest-bearing loans. The accounting challenge was adapting ancient principles to modern banking. How do you operate a bank with all the accounting and regulatory requirements that entails, while avoiding interest? The Mit Kamr Bank didn't survive long. It was closed by the Egyptian government in 1967 for political reasons, but it demonstrated that Islamic banking was possible. Other experiments followed. Pakistan and Iran, after Islamic revolutions, attempted to Islamize their entire banking systems. The Gulf states, enriched by oil wealth, established Islamic financial institutions. By the late 20th and early 21st centuries, Islamic finance had become a global industry worth trillions of dollars. Modern Islamic finance uses contracts and structures derived from classical Islamic commercial law, the same types we discussed earlier in medieval contexts. The Mudaraba partnership, where one party provides capital and another provides expertise, is used for investment accounts. The depositor is treated as an investor providing capital to the bank, which manages that capital and shares profits with the depositor. This avoids interest. The return isn't guaranteed or fixed, but depends on actual business results. The Musharaka partnership, where multiple parties provide capital and share both profits and losses, is used for project financing. If a business needs funding for expansion, an Islamic bank might enter into Musharaka, becoming a partner in the enterprise rather than a creditor. The accounting must track the bank's ownership stake, the profits and losses of the enterprise, and the gradual buyout as the business purchases the bank's share over time. The Murabba contract, where a seller discloses their cost and adds a transparent markup, is used for asset purchase. If someone wants to buy a house, an Islamic bank might purchase the house itself and then sell it to the customer at a higher price payable in installments. This looks economically similar to a conventional mortgage. The customer makes monthly payments, but the structure is different. The bank owns the asset and sells it rather than lending money to buy it. The accounting must reflect this. The bank's books show an asset purchase followed by a sale, not a loan and interest income. Sukuk, often called Islamic bonds, are investment certificates representing ownership in assets or projects. They're structured to provide returns based on asset performance rather than as interest payments. A company might sell sukuk to raise capital, promising to share profits from a specific project with sukuk holders. The accounting for sukuk is complex, requiring clear tracking of the underlying assets, the income they generate, and the distribution to certificate holders. All of these modern instruments require accounting systems that track not just cash flows, but the underlying real economic relationships. In conventional finance, a loan is a loan. One party owes money to another, interest accrues, payments are made. The accounting is relatively straightforward. But in Islamic finance, the accounting must reflect partnership relationships, asset ownership, profit and loss sharing. This is more complex but arguably more transparent, showing the actual economic substance of transactions rather than just financial flows. The calculation of zakat continues as a religious obligation for Muslims, and modern Islamic finance has had to develop methods for calculating zakat on contemporary financial instruments. How do you calculate zakat on a mutual fund investment? On sukuk holdings? On a business that owns both zakatable and non-zakatable assets? Islamic scholars and accountants have developed methodologies, often drawing on classical principles but adapting them to modern circumstances. Modern Islamic financial institutions employ Sharia boards, committees of Islamic scholars who review products and practices to ensure compliance with Islamic law. The accounting must be sufficiently transparent that the Sharia board can verify that profit-sharing ratios are being calculated correctly, that no hidden interest is being charged, that all transactions conform to Islamic principles. This creates additional accounting requirements beyond what conventional financial institutions face. The tension between Islamic principles and modern financial reality sometimes creates challenges. Islamic finance operates within a global financial system that is fundamentally interest-based. An Islamic bank that avoids paying or charging interest directly still must interact with conventional banks, with central banks that set interest rates, with financial markets where interest rates affect all asset prices. The accounting must navigate this tension, ensuring compliance with Islamic principles while operating in a non-Islamic financial environment. Critics of modern Islamic finance sometimes argue that it's just conventional finance with different labels, that murabaha house purchases are economically identical to mortgages, and calling them something else is window dressing. Defenders argue that even if economic outcomes are similar, the underlying relationships and the consciousness about the nature of transactions matter. The debate continues, but the industry has grown dramatically, suggesting that many Muslims find value in financial services that at least attempt to comply with Islamic principles. The accounting innovations required for modern Islamic finance have contributed to global accounting practice in some ways. The emphasis on asset-based transactions, on tracking underlying economic substance rather than just legal form, on transparency about profit calculation, these align with broader movements in accounting toward fair value measurement and economic substance over legal form. Islamic finance's requirement to account for partnership relationships and profit sharing has parallels in accounting for joint ventures and complex ownership structures in conventional finance. Now let's turn to the broader legacy of Islamic accounting in the development of modern accounting practices worldwide. The transmission we traced earlier, Hindu-Arabic numerals, algebraic methods, systematic record-keeping practices became so thoroughly integrated into European and eventually global accounting that their origins were largely forgotten. The double-entry bookkeeping that emerged in Renaissance Italy and spread throughout the world has clear conceptual connections to Islamic accounting methods, even if the specific system developed independently. Luca Pacioli's 1494 treatise on double-entry bookkeeping is often considered the foundation of modern accounting. Pacioli didn't invent double-entry, he was describing practices already common among Italian merchants. But his systematic exposition became the standard reference. The principles he described, recording every transaction twice, maintaining balance between debits and credits, organizing accounts systematically, performing regular reconciliations, became the foundation of accounting education and practice. These principles, while developed in their specific form in Italy, built on concepts that had circulated through the Islamic world. The idea that transactions have two sides, that systematic organization of records is essential, that accounts should balance, that documentation enables verification. Whether this influence was direct or indirect, conscious or unconscious, the conceptual continuity is clear. Accounting developed not in isolation but through cross-cultural exchange, with Islamic civilization playing a crucial intermediary role between ancient and modern practices. The Hindu-Arabic numerals that Pacioli and all subsequent accountants used were the foundation of everything. Try doing sophisticated accounting with Roman numerals, and you'll quickly appreciate how essential positional notation with zero is. Every financial statement, every ledger entry, every calculation in modern accounting depends on this numerical system that reached Europe through the Islamic world. This is so fundamental that we take it entirely for granted, but it represents one of the most important knowledge transfers in human history. The concept of the waqf, the perpetual charitable endowment, influenced European legal and accounting thought about trusts and foundations. European charitable trusts and endowments developed their own legal frameworks, but the basic idea, property dedicated to charitable purposes in perpetuity, requiring specialized accounting to ensure proper administration across generations, has parallels to Islamic waqfs. Whether the influence was direct or whether similar needs produce similar solutions, the accounting challenges are analogous. Modern government accounting, with its emphasis on accountability, transparency, and systematic record-keeping of public funds, has roots that extend through Islamic administrative practices back to ancient Mesopotamia. The Diwan system of administrative departments, each maintaining accounts of its particular responsibility, influenced Ottoman administration, and through Ottoman contact influenced European administrative development. The idea that government finances should be systematically accounted for, that records should be maintained and reviewed, that accountability requires documentation, these principles were developed and refined through centuries of Islamic administrative practice. Corporate accounting, which emerged as joint stock companies developed in the 17th and 18th centuries, had to solve problems similar to those Islamic merchants had faced with partnerships. How to account for multiple investors, how to calculate and distribute profits, how to maintain records that all parties can trust. The solutions developed in different contexts, but the underlying principles, systematic record-keeping, clear profit calculation, transparent distribution, were similar. Cost accounting, which developed in the Industrial Revolution as manufacturers needed to track production costs, had precedence in Islamic administrative accounting. The calculation of what it cost to build an aqueduct or maintain a navy, the tracking of materials and labour for construction projects, the determination of fair prices based on actual costs. These were all practiced in medieval Islamic administration and influenced later European practice either directly or by demonstrating that such accounting was possible and valuable. Auditing, the independent verification of accounts, has roots in Islamic practice. The muhtasib inspecting merchants' weights and measures and accounts, the qadi reviewing a waqf nazir's records, the caliph's officials checking tax collectors' accounts, these were all forms of auditing, of independent verification that accounts were honest and accurate. Modern auditing developed its own specific practices and standards, but the fundamental idea that accounts should be subject to external review has a long history that includes Islamic precedents. As we consider this long history, from clay tablets in Sumer to the House of Wisdom in Baghdad to double-entry ledgers in Venice to global accounting standards in the 21st century, we see accounting not as a static technique, but as an evolving human practice, shaped by culture and religion and law and technology, but always serving the same fundamental purposes: to remember, to account for, to enable trust, to organize complexity, to make visible the invisible relationships of economic life. The Islamic contribution to this long story was substantial, Islamic civilization preserved ancient knowledge that might otherwise have been lost. It synthesized knowledge from diverse sources, Greek, Persian, Indian, creating new mathematical and administrative methods. It developed sophisticated accounting practices for commerce, government, and perpetual charitable endowments. It transmitted this knowledge to medieval Europe, making possible the accounting innovations of the Renaissance and early modern period, and it continues today in modern Islamic finance, adapting classical principles to contemporary needs. But perhaps the deepest legacy is conceptual. The idea that accounting matters, that systematic record-keeping is essential to civilization, that numbers can organize complexity and enable cooperation, these ideas were developed and refined over millennia, with Islamic civilization playing a crucial role. We live in a world where accounting is ubiquitous, where every organization maintains accounts, where financial statements are expected and examined, where the question, "Where are the numbers?" is a demand for accountability and transparency. This world was built in part by the scholars in the House of Wisdom, by the merchants in Baghdad's souks, by the nazirs managing waqfs, by everyone who understood that numbers could serve justice and enable trust. The work of those ancient and medieval accountants, patient, meticulous, often anonymous, echoes still in every transaction recorded, every balance calculated, every account reconciled. They built systems that allowed strangers to cooperate, that allowed trade to span continents, that allowed charity to continue across generations. Their legacy is the world we inhabit, organized by numbers, made possible by trust, sustained by the quiet discipline of accounting. Let it all drift away now. The clay and the paper, the dinars and dirhams, the careful columns of figures. Let yourself settle deeper into rest. You don't need to remember any of it. The numbers will take care of themselves as they have for thousands of years, organizing quietly, accounting patiently while you sleep. Good night. Let go. Sleep well.